This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keane in New York. Now we continue to track COVID-19, and of course, no one better to talk about this than the leading authority on the pandemic. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Joining us now is Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. Dr. Adalja, thank you for joining us. It seems that the vaccine that Moderna, talked to us about yesterday is much easier to distribute because of the need for refrigeration actually at a lesser level for 30 days. Is this a game changer?
I do think that this is going to end up being probably one of the first generation vaccines that is the vaccine of choice, because everybody was excited about the Pfizer efficacy numbers, but we weren't so excited about the fact that it needed to be stored at -70, -80 degrees centigrade. The Moderna vaccine, because it can be stored at normal, achievable temperatures that don't pose a major logistical challenge, does make this prospect a little bit easier. It's still going to be daunting, but it is going to be something that is much less complicated when you don't have to think about freezer farms and trying to make sure that the cold chain remains intact.
If you look at the Pfizer vaccine and the Moderna vaccine, there are a new generation of vaccines called mRNA. What do we understand about them? What do we know about them? And can they actually change vaccine development forever?
I do think this is the case. mRNA vaccines are going to have, a major impact, I think, on vaccine development in the future. And these are the first two that we're really seeing in advanced clinical stages. But what they offer is the ability to very elegantly be able to make a vaccine quickly and put it into clinical trials, because all you need to know is the genetic sequence of whatever you're trying to immunize against. And then you can basically print it off and then inject that gene into people, and then your cells start to make that protein and your immune system reacts to it. So the fact that you can do this so quickly may make a lot of vaccines that have been out of reach or been too expensive because of the cost of research and development much more within reach. And it could change the way we think about emerging infectious disease outbreaks, and there are also applications for cancer and other types of vaccines. So this really, I think, will jumpstart the mRNA vaccine field, and I think will likely pay a lot of dividends in the future when it comes to public health and other medical conditions.
Dr. Adalja, talk to me a little bit about whether the fact that this is a new vaccine, there will be a lot of misinformation. Will, fewer people want to take it, given the very nature of these vaccines that we haven't tried out yet?
This is a definite possibility. Even for vaccines that have a lot of information, we have people who will be susceptible to misinformation and lies about them. And we have a very vibrant and vocal anti-vaccine movement that is poised to pounce on this vaccine the minute it is approved. So I do think we're going to have to be very transparent about the risks, the safety profile, the risk-benefit ratio in a way that we really haven't. Because if this vaccine doesn't get into the arms of the world's people, it's not going to be a worthwhile vaccine. So we have to really make sure we get this right, because during the 2009 H1N1 pandemic, we didn't see very great uptake with that vaccine, and it was something that was done using tried and true flu vaccine technology that wasn't new. So this is going to be even a little bit more difficult of a communications issue, but we do have to start to be proactive about it, and I do think we will get a safe and effective vaccine based on the data that I've seen. But again, there's just always that issue when you're doing something new in the middle of a pandemic, and this perception that this was rushed versus the fact that this is just a function of the fact that they used a really innovative technology that allows you to go fast.
How are hospitals coping? Which hospitals and states are actually at near capacity?
Well, this sort of changes every day, but the ones that we're worried about now are still North and South Dakota, Wisconsin, Iowa, Utah, El Paso, Texas. That's where we're hearing the most stress that's going on. And there are likely going to be more, and this is going to be roving. Every hospital now in the country is dealing with COVID-19 patients for the most part. And they're dealing with a higher number than they had even during the peak in the spring. So this is something that is not sustainable if we don't get some level of control, just enough to have some breathing room, because hospitals are not only taking care of COVID-19 patients, they have to do everything else. They have to take care of heart attack patients and trauma patients and stroke patients. And we don't want that care to be compromised compromised. So we have to get some level of control so that the vulnerable populations are not getting hospitalized. And that's what we continue to worry about. That's what flattening the curve is about to me. It's trying to keep it below hospital capacity to a manageable level. And I think we're failing because many states do not have the public health infrastructure to intervene on these cases. And you have a population which is really not listening about the fact that we live in a pandemic and you have to take some common sense precautions.
Does that change with the Biden administration? I keep on reading these, frankly, incredible stories in U.S. press of people dying of COVID-19, but not believing they have it.
I do think it will change with the Biden administration, but you have to remember that the Biden administration isn't going to take office for over 60 more days. So this train will continue to accelerate. It is going to become harder and harder to stop. But I do think that the plan that's been outlined by the Biden transition team about really investing in testing and rapid testing and in at-home testing, as well as looking at hospital capacity. And I do think also just the simple fact that you wouldn't be getting misinformation, you wouldn't be getting lies, you wouldn't get undermining of experts like Dr. Fauci, you would have the CDC back in the front seat driving this. All of that's going to make a major difference in how the American public think about this pandemic. It's just that we have to wait 2 months for that. And I think there's still a lot of damage that's going to be done between, and people are going to die between now and then.
Amish, thank you so much. Amish Adalja there of Johns Hopkins. Be sure to check out VRUS Go on the Bloomberg. Now, coming up, we have plenty more of the New Economy Forum with Christine Lagarde.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
We
seen a massive momentum shift in the last week that we don't think investors should be ignoring.
The market in the next 2 months seriously will start to reprice everything.
Growth will pick up a lot in the second half of next year as people get back to normal.
Normal doesn't look like January of 2020. The world is different.
People have money and they want to spend and they can spend, and I think they're going to.
We've been in a bull market. We remain in a bull market.
We're now through the election and we can sort of face forward into what I think is going to be a very big 2021.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market pulling back from all-time highs. Tom Keene, record high COVID cases meets record high stock markets. That is the stark contrast of the last couple of weeks.
The VIX down to a 22 print. We're just back to 23.17. I'm going to call it market churns. John, you'll do a data check better than me. What I would look at is the news flow that's out there. And John, the clear message I get in every surveillance conversation is corporations are adapting and adjusting to a slowing economy, knowing those vaccines are out there. Obviously, the celebration yesterday.
And that's the market celebration, Tom. Society's celebration about the future, the forward outlook, not the here and now. Nothing to celebrate about the next couple of months. President-elect Joe Biden talking about a dark winter for the next 3 months, Tom. The South Side has started to push back this morning. I think that's important. SocGen, it's understandable, but it's unsustainable. That was Kit Jukes. Bank of America saying the bull might be full. Maybe you should sell the vaccine. Just a little bit of pessimism, or at least questioning the euphoria of the last couple of weeks.
And you see it in the minutia right now with a cyclical play down. We've got red in the screen, SPX and Dow, got green in the screen, NASDAQ 100. John, I mean, you're going to get the back and forth, and somebody's going to be right 6 months later. Somebody's going to be wrong. What I would suggest is you've got 2 quarters of slowing GDP, and then the real debate is what happens out second and third quarter next year. That's what all those year-end outlooks are going to be. John, I know you read every word of every year-end outlook.
Love them all. I wonder how many will have to be rewritten after the next few months, Lisa Abramowitz, given what's happening in the United States of America.
Quiet on the floor.
We're not got quiet on the floor.
My entourage, John, I'm sorry, my entourage was talking here. Quiet on the floor,
the entourage being Tom Keene.
How many people have you got over there?
I got my usual 4, 5, or 6, which is unlike your 10 or 12 in London.
That is the entourage Tom Keene would love. I've no idea where he's going with this, but he'd love 10 people just like him, surrounding him at all times, and they could all just look at each other.
John, you're entourage.
I think he's
on
playing
radio and TV.
all roles right now.
Lisa, what's so important here is Farrell went over to London, and it's just unreal, the entourage he's got off Queen Victoria Street right now.
They just trail out
Let us
behind
continue.
him. Just to bring us back to what we're talking about and to really weigh in on what John was talking about, there is a question about the entry point, the idea that there's a brighter future, but how much pain needs to be felt in the near term and how much pain is currently being felt in the real economy. 8:30 a.m., we will be getting a read on that with U.S. October retail sales. The expectation usually is for October sales to increase. This may be different because we are seeing momentum decline. What are people going to spend their money on if they have to be home and there are restrictions? 1 p.m., Fed Chair Jay Powell is speaking at a Bay Area award ceremony. I'm very interested to hear what he has to say about extending the maturity of the bond purchases they do every month, $80 billion. We did not get any signal from Rich Clarida, the vice chair, yesterday, but this seems to be a bet in markets. They will make a decision on this in their meeting next month. And at 2:15 p.m., I did this for you, Tom, Senate is holding a procedural vote on the Fed nominee, Judy Shelton, and there actually has been some pushback recently by some Republican senators saying, we're not that keen on the whole gold standard thing and the whole non-independence thing, but, if they basically pass her through this procedural vote, she will be up for confirmation.
Yeah, it's really on the knife edge. John, I mean, this is like, it's a distraction. It's not like front and center, but I think knife edge is the word that's being used right now for, did they get Governor Shelton to be a governor?
Last 90 seconds on the show has been a total distraction. Can we just talk about Chairman Powell, the Bay Area Council Business Hall of Fame? Are you in that, Tom?
No.
Did you make the Bay Area Council Business Hall of Fame?
No,
made it yet?
No, can we, John,
Chairman Powell might be.
Can I look at the headline of the moment, John, which really seriously
please
really,
do.
really
Actually,
matters.
please do.
Walmart right now with that headline from the CEO, John, and this really speaks to where we're going. The idea that new customer behavior will persist. John, that's the money headline for the next 90 days.
sticky might be the word you hear a whole lot more of over the next 12 months. Let's get to the price action of this morning, this Tuesday morning. Good morning to you all. I'll whip through things for you. A little bit of optimism over the last week, a lot of optimism for that matter. Euphoria maybe. Futures decline. We pull back a little bit on the S&P 500. We advance on the NASDAQ. Into the bond market we go. Treasuries did not participate in the move yesterday. Basically unchanged, a move of a basis point or so. We come in a basis point this morning to 0.89%. Euro dollar, the euro started to make a move. Christine Lagarde speaking a little bit later. It's a day, it ends with a Y. You will hear from the ECB president. Euro dollar 118.75. I'm not complaining. Crude down about 0.25% to $41.24. Joining us now to kick off our program this morning, Mona Mahajan, Allianz's Global Investors US investment strategist. Mona, Kit Dukes of SocGen said this morning, understandable the last week or so in this market, but unsustainable. Do you share that?
I actually think that the rotation part of this equity move is somewhat sustainable. So, we see, of course, in the next few months, we may get some volatility. We're still not through the toughest part of this virus and this pandemic. But beyond that, I think the incremental news we got this week and last week was not only vaccines, but vaccines that were over 90% effective, or 90 and 95% effective. Even the scientists in their wildest hopes were not expecting 2 vaccines that would produce that. So in our mind, that's incremental news that could get us through this pandemic in the next 12-month period. And so for us, when you think about 2021, where growth may start to reaccelerate because you have a true reopening, not only in the US, but globally, rates will probably remain low, at least through 2021. And you have the potential for fiscal stimulus and maybe some fiscal spending. That's not a bad backdrop for risk assets broadly. So overall, we continue to feel that if you have some periods of volatility, use that tactically. If you haven't already layered in some cyclicality, some non-US assets, start to think about that.
Mona, Walmart's breaking out to a new high. Are corporations going to adjust to all this? I mean, the bears are there. John's mentioning the gloom of Abramowitz, the gloom of SocGen, and the rest of them as well. Mona, just as simple as I can, are we underestimating the ability of corporations to adapt to this pandemic?
Clearly this pandemic has accelerated some key trends. So we've seen brick and mortar to online retail, and Walmart's a clear beneficiary of that. They've accelerated their online programs. But also things like, a more work from home employee base. That's been accelerated through this. We think that's here to stay to some extent, supports cloud computing, supports cybersecurity, going from, medical visits in person to telemedicine, another trend that's probably here to stay. So there's several trends that we are seeing that corporations probably had been thinking about, but now really have to get on the ball. These trends have been accelerated through this pandemic and are likely here to stay to some extent. And so that's why we still think a balance is important. Some of these quote unquote stay-at-home stocks are actually, they have 3, 5, 10-year secular growth trends behind them. And so it's important to have that part of the exposure as well. But, we could see a few months at least of really strong outperformance from the cyclical part of the market as well.
Mona, one of the hardest aspects of this moment is there's the near term, as John was talking about, that's looking darker and darker, and frankly, darker than a lot of people had expected with respect to the pandemic's trends. And then you have the longer term, or the even intermediate term, which looks better than expected given the efficacy of some of these vaccines. You said in periods of volatility to take advantage and go long into the trades that you're talking about. What counts as volatility? What's the entry point that you're looking for?
Yeah, it's a great question because in some cases, and certainly since the start of this quarter, we haven't gotten many pullbacks. In fact, the S&P is up 7.5 or 8% since September 30th, and some of the cyclical sectors are up 13, 14, 17%. So we haven't quite seen a dip to buy quite yet. We do think over the next 2-month period through year end, you're not going to get a continuation of this straight upward movement. There will be pullbacks. Keep in mind, in any given year, 3 to 5 pullbacks in a 5 to 10% basis or 5 to 10% range are normal and are probably healthy. If we go through another period like that, certainly ahead of 2021, I think it's important to start thinking about how you want to position as these vaccines get rolled out, as hopefully we start to see this change and shift in consumer behavior, perhaps a little bit back to pre-pandemic activity levels. And so we do think we'll get a period of consolidation that can be used to position yourself accordingly. So it's important to watch for that.
Mona, to what extent do you think that people were conditioned by the price action of the spring and conditioned to look through what's playing out in America right now? And I wonder what you think the fallout of that actually is.
Yeah, it's a great question, because clearly when the Fed stepped in March, and they stepped in a big way, not only bringing rates back down to the lower bound, adding QE, adding these credit facility programs that really supported the functioning of credit and equity markets, they really did put a bit of a backstop into this market. And so it does feel like markets are conditioned to buy that dip. What we'd say is it's important to stay a little bit active in how you buy these dips and how you position yourself in the marketplace. If you want to have performance that's in line with the broader indices, you do need to think about your weighting in certain sectors, in certain regions, et cetera. And so there is a bit of conditioning, but we think it could be more than just buying the overall market. It's how you position as you move forward. But as long as the Fed is there, as long as global central banks are in play, we think there is a bit of a backstop in the market. And that's to some extent helpful, but longer term, we'll see what the consequences are.
Mona, great to catch up. The Fed is there.
Thank you,
with
guys.
or without Judy Shelton. Mona Mahajan from Allianz Global Investors, thank you. Fed Vice Chairman Richard Clarida speaking yesterday. And guys, I've got to say, did he sound optimistic and confident? Here's a quote, a line from what he had to say. I've got more conviction in my baseline for next year and more conviction that the recovery from the pandemic shock in the United States can potentially be much more rapid than it was from the global financial crisis. The number two at the Federal Reserve with a pretty bright outlook for 2021, Tom.
Well, there's a lot of different opinions out there, but it's good to see that from the vice chairman. I mean, I know that Dudley's going to be along here in a moment. John, there's all sorts of opinions out there, but the number one thing is there's a set of wall of worry along with a wall of money.
A wall of worry, a wall of money, and Lisa, JP Morgan, I understand, think the Fed might add to it.
Well, that's the interesting thing, is that even though Rich Clarida is really optimistic, people are still basically pricing in an extension in duration, extension in maturities in the asset purchases by the Federal Reserve.
Guys, we're almost at Dow 30,000.
Tom, it's unreal.
30,000.
You follow the Dow. You've got this.
Okay.
I know, it's important.
S&P 4,000.
Turkey. Brian.
We're getting there.
Would you be quiet, please?
Thanksgiving.
The intern from the Rhode Island School of Design is just...
I have no idea where the show's going. I feel like that every single morning. I do know that coming up shortly is former New York Fed President Bill Dudley. I'm looking forward to that conversation. Yes. Kevin Cirilli down in Washington, D.C. as well.
Maybe.
President-elect Joe Biden, here's a serious note for you. We're going into a very dark winter. More to come. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Joe Biden's call for Congress to pass a larger-scale stimulus package has run into swift Republican opposition. The president-elect wants something like the $2.4 trillion bill the House passed before the election. But Senate Appropriations Chairman Richard Shelby says that's not happening soon, and it probably won't happen later either. America's effort to revive its virus-battered economy has been put on pause or thrown into reverse. Across much of the country, new infections are soaring at the fastest pace since the earliest days of the pandemic. California has reimposed bans on many indoor businesses. Michigan has ordered a partial 3-week shutdown, and Oregon, Washington, and New Jersey have tightened restrictions. Turning now to another of Elon Musk's companies. Shares of Tesla are soaring today. The electric car maker will join the S&P 500 next month as its largest ever new member. Before today, Tesla's shares had risen almost fivefold this year, giving the company a market value of almost $390 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate, consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
Right now, Congress should come together and pass a COVID relief package like the HEROES Act that the House passed 6 months ago. Once we shut down the virus and deliver economic relief to workers and businesses, then we can start to build back better than before.
Build back better than before. We've heard that a lot, not just in the United States, also in the UK over the last year or so. Joe Biden, president-elect there, pushing for more fiscal stimulus. A Congress that isn't budging right now. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action of this Tuesday morning. We'll pull back from all-time highs at the open potentially, with the S&P 500 down 15 points. We're negative 0.4%. The NASDAQ, that's where your outperformance is. It speaks to the defensive posture of this morning. Yields come in by a basis point or two on a 10-year to 0.89%. Crude, pairing some of the recent gains at $41 and about 27 cents. And euro-dollar, keep an eye on the euro. Bit of euro strength, some dollar weakness is broad-based. I'll talk about that a little bit later in the program. The Chinese currency just seems to be the shock absorber at the moment in the FX market. Euro-dollar, 118.77. Tom will discuss it. Just how tolerant will these central bankers, these countries be of a weaker dollar if it continues to materialize?
I brought that up with John Norman at JP Morgan. I think you're dead on, John. I noticed there, as you mentioned, renminbi out to new strength. And I'd also note I'm watching euro-yen as a proxy on strong yen. Right now in Washington, Kevin Cirilli joins us, our chief Washington correspondent. Kevin, I want to go to sort of the zeitgeist of the morning, which is who is advising the president? There seems to be a confusion about a secretary of offense where the president wants to go into Iran and do things, or a secretary of defense where he wants to get out of Afghanistan, get out of Iraq, get out of Somalia, and Mitch McConnell saying you're nuts. Who's advising the president?
Well, reportedly, the President Trump met with some of his top national security advisors, including Secretary Pompeo, to discuss withdrawals from the Afghanistan region, as well as a potential military strike against Iran. But that, according to these reports, he decided against that. Meanwhile, we should note that should he want to utilize significant military force, he would need to get congressional approval, should it be boots on the ground or with regards to that. And quite frankly, as you just alluded to, Tom, Senate Majority Leader Mitch McConnell is not likely going to provide the appetite for that in a lame duck session. Meanwhile, in contrast to that, the president-elect's team, Joe Biden, has been hosting briefings with national security security advisors for the media and whatnot. And we should note just the careful role that Tony Blinken, his longtime aide, will play, in no doubt, in the transition and obviously in the administration as well.
Kevin, the other side show, and I know you're up to speed on this way better than we are, is the two Georgia distractions. It's a Georgia distraction out there right now. How at risk are the Republicans to mess up this election? They're supposed to win, right?
They are supposed to win. This is theirs to lose. There are 2 Senate seats in the Georgia runoffs up for grabs in the first week of January. And look, make no mistake that I speak with Republicans who have told me that they welcome President Trump's ability to campaign, to mobilize various Republican contingencies who are not likely to vote unless that there's a large path for Trumpism, conservatism support. And there's a lot of different moving pieces now, both in conservative media circles as well as where super PACs are going to be going in conservative money circles. And all of that, the first chapter of that could be in January 2021. It will be, based upon my reporting, in January 2021. Who's going to be able to claim conservative victory, not just in terms of the candidates, but in terms of how they were able to do that. And that's what's really happening. That's the jockeying going on behind the scenes.
Kevin, I appreciate the focus on 2021, on politics and on markets as well, but we need to focus on 2020 and what's happened in America in the last 24 hours. Philadelphia closing down indoor dining, your home city. We're looking at a situation in California deteriorating. In the words of the governor, Newsom, the rate of increase is simply without precedent in California. What's happening down in Washington on this front?
Not much. Look, I think to answer this question bluntly, I mean, Senate Majority Leader Mitch McConnell has looked at the positive developments from Pfizer on the vaccination front, as well as Moderna on the vaccination front, as an argument for a more targeted stimulus approach and not a more wide-sweeping stimulus approach. In contrast to that, President-elect Joe Biden working the phones, working the virtual town hall meetings of sorts, and trying to urge Democrats and to some extent Republicans privately to get on board with a larger, broader sweeping stimulus package. So, you know, not much. I mean, the goalposts haven't moved in terms of where stimulus funding and talks are.
Meanwhile, it's not just the money aspect, it's also the comprehensive plan that the United States has to roll out the vaccine and get the coronavirus under control. How closely is the Trump administration working with the Biden administration at this point? I know Biden's administration has complained that they haven't really been in any kind of discussions. What's the latest on that front?
2 points. Publicly, nothing. Even back channeling, very little. I'm not able to report that there's been any significant serious conversations on that regard. But the second half of this, right, is incredibly important. It's peaceful transitions of power are deeply rooted in American history. It's a sobering tradition and one that has deep roots dating back to George Washington. But behind the scenes, the bureaucrats, the career officials at the various agencies and the health institutions in the United States, the people who were there in the Bush administration, the Obama administrations, the Trump administrations, and yes, the Biden administration. Those individuals have been working on this for decades in the sense of the supply chain. The supply chain already exists. When I talk to bureaucrat health officials, the supply chains are there, and the rollout, that's why Moderna is saying that they might be able, should they get approval, Tom, they might even be able to have it rolled out by the end of the year, Kevin, for certain contingencies.
Kevin, nobody cares. What they care about is a gentleman from the 2nd Congressional District of Philadelphia apologized for the nation on the performance of the Philadelphia Eagles. Do you agree with Congressman Boyle that the Philadelphia Eagles are a national embarrassment?
I don't think that. I mean, wow, now I don't think they're a national embarrassment, but because I'm talking publicly. But behind the scenes, privately, I have been known to gripe like Congressman Boyle. And I got to say, you know, I mean, I got to be careful because I'm on TV, so I don't want to say what I'm thinking.
Don't worry, Kevin.
John,
But I have thoughts. I have thoughts, and you're tempting me and baiting me, and I have thoughts.
I have thoughts, John.
Kevin, given how we opened this show about 20 minutes ago, there's no one left on Bloomberg Radio or Bloomberg TV.
Please.
I guarantee. Kevin,
it's
great
good to be
catch
back.
up. Kevin Cirilli, welcome back. Bloomberg Chief Washington Correspondent. Kevin with us through the week on the latest down in Washington, D.C. Tom, the states are making their move. The states are making their move.
John,
where's the federal follow-up?
John, I am so glad you brought us back to the pandemic, because in all this happy talk about the markets, Dow through 30,000 and the rest, the news, folks, of the Bloomberg virus update is grim today, like it was in those days of April.
Just a couple of weeks away from Thanksgiving. Coming up on this program, Kevin Giddis, Raymond James, Chief Fixed Income Strategist from London and New York this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From London and New York, this is Bloomberg Surveillance. We pull back from record highs. This is what defense looks like in a world of cyclical hope. Equity futures declined 0.4%. The Nasdaq positive, small caps negative. This morning, just a little bit of pushback from the south side, starting with Bank of America and their fund manager survey. A lot of hope in that. BofA saying, sell the vaccine. Maybe this bull is full. Switch up the board and get very quickly to what is happening in foreign exchange and in the bond market. I want to talk about FX just a little bit and start with what is happening in treasuries first. Yields are starting to push out just a bit last week, just the tiniest bit to 97 basis points, and that's where we topped out, and then things rolled over, and that's where we've stayed. Many people making this call that we would get this weaker dollar. That weaker dollar's not come through in a very pronounced way, apart from one currency pair, and that is dollar China. Treasuries this morning, 88 basis points. Take a look at dollar yuan. I want to have a look at the offshore first, but you can look at the onshore as well. Dollar China peaked at the back end of May. We've had a move of 8-9 percentage points down. Stronger Chinese currency since then. Dollar China right now, 655. That's what you need to keep an eye on. Just how much of this will we tolerate on a central bank side of the ECB, the BOJ, and also at the country level in China too. I want to finish on this, though, just briefly. It's the move in dollar yen. Kit Jukes of SocGen saying that maybe what we've seen over the last couple of weeks is understandable. He thinks it's unsustainable. And if you want to add some longs, Tom, add it into the Japanese yen. Kit Jukes, long yen, on the fact that I think maybe some people think this has gone too far.
Well, strong yen 103, 102 really hasn't happened. What I would note, John, is euro, where a lot of the pros we talk to talk about strong euro into 130, 140 is being angst. I just flat out don't agree with that, John. To me, what we have seen on this show are people getting upset at a 122, 123 euro. How much does it take for strong euro really to be a problem?
Last time it was a problem, it was 120. And we're not far off that right now, Tom. And I'd say that would be the level again.
Amazing.
We haven't quite breached the levels of a couple of months ago, but it's tough.
I mean, his entourage got him on the litter from the data check floor over to the desk there in that quick a time. It's incredible how they
It's about 20 feet. I get carried.
Yeah, you get carried. I understand
They're
that.
good.
Yeah, well, Francine's off, so you use her litter. Kevin Gittes with us right now with Raymond James. We look at fixed income here. Kevin, what's so great about your work is it really devolves down to what people do with coupon and what people do trying to protect total return. I believe it's yield up, price down. How do you protect total return?
Well, the only way to protect total return time would be to shorten duration or enhance credit. And so we have stopped really short of starting to walk up the duration curve a little bit in order to protect that trade. And the idea behind that is you find a resting place if you really think yields are going to run up, as we talked about earlier, between now and the end of the year. We're not necessarily there. I mean, we made a 1% 10-year forecast in March, and now we're trying to, hopefully we live with it and it's true. But what we saw last week is there's the potential to push rates higher. But this week hasn't been that case, even though most of the news is good. So I'm still a little bit skeptical that we've got to pull duration in, but it looks like the better trade to try and protect whatever total return you have. There's just not that much difference between 10s and 7s.
Whenever we get investment strategists on, Kevin, they always talk about Fed being the ultimate put, and they're expecting the Fed to step in with extending the duration of their purchases at their meeting next month. Their $80 billion of Treasury purchases a month. Do you think that they will do this, and why?
Well, and I don't see, I'm a little bit on the other side of that. I really don't see that happening. If you looked at last week's numbers, the Fed balance sheet at $7.15 trillion, they added, less than $20 billion to the portfolio. Of that, $15 billion were treasuries. So I think they would like to have that portfolio to $7.5 trillion. I don't think that they're going to go rush and do that. I don't think the conditions are such that they need to. And you look at the curve for that validation, I just don't see that they're going to go out and pump a bunch of securities into the portfolio between now and the end of the year. And certainly after we know what next year looks like from a vaccine standpoint.
This is the game of chicken, Kevin, because we've got markets that expect the Fed to step in before there's even a disruption, let alone any sign of consternation, perhaps, if the virus is getting that much worse. And on the flip side, as you said, it doesn't really seem like the conditions are there, and Vice Chair Clarida did not seem to be particularly pessimistic yesterday. What's the market reaction? How disruptive is it if the Fed does not step in with that extension of duration?
Again, I don't think all that much. I think Clarida in particular, and we've got a whole host of Fed speakers this week, hit on really 2 points. One, his excitement for the vaccine, and two, the fact that rates are going to stay low for a long period of time. And I would say if I added another one, it's been the banging on the drum, is the need for fiscal support. So they're still trying to get Congress to come up with a package that takes some of the pressure off doing what you're actually talking about them doing. So I don't think there's a big market reaction if they don't. But I do think if we start to see this economy slide down and there's a period of time before the vaccine and there is no stimulus, it will react and probably react that would take us back towards 60 basis points on 10s versus 1%.
Kevin, where do you expect the pain to show? You've talked about the Treasury market there, down to 60 basis points from about 88, 89 right now. Do you expect to see any pain in credit? There's a real comfort at the moment, looking at the credit markets for many investors that just say the Fed's got our back. If things go wrong, they'll step in again. Where does the pain show?
Yeah, so John, the part that really, we'll say baffles me is that IG spreads have come in a little bit since the beginning of the month, but high yield spreads have come in 70, 80 bips since the beginning of November, and then volatility has gone down during that time. So I think we're not done with bankruptcies. We're not done with business closures. And it'll go beyond the energy space. The energy space is about 44% of all defaults in the high yield market. There are other sectors like telecommunications and others that are seeing down credits. And if we looked at the upgrade downgrade ratio to high yield in particular, downgrades are leading 5 to 1. So I think there's the pain trade. The pain trade is for all those that reached out to try and get yield, and I think you'll see spreads widen before the end of the year.
Well, back in spring, Kevin, we saw a huge dislocation at the front end of the yield curve in credit markets. In investment grade particularly, it was phenomenal, and not in a good way. Has the maturity profile of some of these companies changed sufficiently now in a material way over the last 9 months that we might not see a repeat of that?
Yeah, no, that's a great point that you bring that out. I think most of the financings and refinancings have been much shorter than where they would normally be given this opportunity, but that's about cash buildup. So I think if you look at state, county, municipal, I think they're doing deals to provide themselves with liquidity to offset lack of revenues. I think we're seeing it in some of that high yield space too, but I think we'll see more pain in terms of businesses if they can't reopen, or even the potential of another lockdown or closure is going to put further pressure on those credits, especially those high yields they have in their portfolio now.
Kevin, what's the relative opportunity of municipal bonds?
Yeah, this is a space I like a lot, even though it's rallied quite a bit since March in particular. But if you look out there at the landscape in munis, you hardly see a bad outcome. So we've got the runoffs in Georgia in January. Will determine the Congress, and that Congress is either going to raise taxes or they won't. They're either going to have more regulation or they won't. The muni market is positioned quite well for whatever happens. The Republicans aren't going to hurt them, and the Democrats, by increasing taxes, could probably make that trade more attractive. So you can go out 10 years, you can still get 93% of treasuries, and that's a really good trade on quality in munis.
But is the real risk here going out too far? I mean, 10 years for a lot of people is short. They're addicted to the 20-year space. How far out is safe?
Well, I mean, I see to get real value in munis, you really have to go out to about 30 years. I'm not saying that in this market we advocate doing that, but I'm safe there in 10 years. I'm safer in corporate credits somewhere between 5 and 7 years. And I'm not trying to time it. I'm just trying to find a place that I feel safe is going to provide a return and give me credit quality.
Kevin, great to catch up. Thanks for your time, sir. Kevin Giddis there of Raymond James. Thank you very much. Tom Keene, casinos are closing down again, and casinos for some of these cities make up a huge chunk of the revenue streams. And what we heard from the Detroit mayor yesterday was the following line: the budget is not my first concern right now. That's where we're at for many cities across America right now. They've got to make really tough decisions, and the financial ones, the financial considerations, are secondary to what is happening in the hospitals and the ICU units, Tom. across America right now.
Yeah, you can really feel the tension. I felt it outside Mount Sinai last night. John, to be honest, I was walking vet bill out around Mount Sinai, and it's not, to be clear, it's not anything like April, but that tension is back. Nothing like what we see across the greater Midwest. Some of the vectors, John, London is within 2 or 3 days of exceeding the per capita peak of deaths of New York State. I just find that stunning that we're there.
A stat I didn't know, Tom, and very concerning. And you're right to bring up New York is not the hotspot for all the bad news as it was back in spring. Lisa Abramowitz, it's the Midwest. And the numbers coming out of places like South Dakota are really, really concerning.
Well, and the big concern here is that the vector of the trajectory here, if I'm going to talk like Tom, is stunning, and it indicates that don't do that is right. I think everyone's groaning. Is this idea that there are a lot of people who are infected who are not necessarily showing symptoms that are infecting others. We're going to see the consequences of that in the weeks to come. I just want to bring up something that we've talked about over the past few months, which is the bridge to the other side. And the question is, has the bridge been long enough? So far, it hasn't for hundreds of companies that have filed for bankruptcy, even though they've gotten government aid. The question is, how deep will the pain be over the next few months to make the bridge insufficient to get to that other side, John? And that is sort of the big unknown as we enter into a tough winter.
You've got to get better at interrupting and maybe cough a few times as well when other people are speaking. That's a little bit, there you go.
I don't mean to interrupt, John, but is that good?
Yeah, but I meant to interrupt. Gets me every time. Don't understand it. I wonder what the guest feels like, Lisa, when he does it. I don't mean to interrupt, but they're kind of mid-sentence.
It depends.
Just getting their point out.
They're the people who just run right over him, which might be the right approach. And then they're the people who just immediately stop.
It's radio. It's TV. Keep
the conversation never starts if you keep interrupting them.
Velocity. Keep it going.
It never begins.
Keep it going.
I'll keep it going. Coming up on the program, Tom Forday, D.A. Davidson, Senior Research Analyst. We'll keep it going.
Forday won't stop talking.
On Amazon and the push into medicine coming up. Really important conversation. Down 21 on the S&P. We declined 0.6%, just off session lows. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. Mark Zuckerberg and Jack Dorsey will be defending themselves again today. The CEOs of Facebook and Twitter will testify before the Senate Judiciary Committee. For the second time in a month, they'll have to answer critics who say their social networks silence conservatives. President Trump is rushing to leave his final mark on energy, financial and foreign policy. He's preparing to cut troop levels in Iraq and Afghanistan and is rushing to lease oil drilling rights in Alaska. Meanwhile, he's stalling the transition to Joe Biden. The president-elect warns that further delays could lead to a higher coronavirus death toll. Meanwhile, Senate Republicans are trying to push through the president's controversial nominee for the Federal Reserve Board of Governors, Judy Shelton. Now, a third Republican has said he opposes the nomination, Lamar Alexander of Tennessee. That means approval could depend on whether all Republican senators who support Shelton show up for a possible vote this week. And the strongest storm of the hurricane season has slammed into Central America. It's threatening to cripple a region already hurting from a deadly storm 2 weeks ago. Hurricane Iota came ashore along Nicaragua's northeastern coast as a Category 4 hurricane. Its winds are now 105 miles per hour, and it's likely to trigger deadly mudslides. And Amazon is making its biggest push into selling prescription drugs yet. The world's largest online retailer is launching a digital pharmacy. Shoppers can pay using their health insurance, and Prime members who don't use their insurance are eligible for discounts on the Amazon site, or at about 50,000 pharmacies. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Announcement of the vaccine, the news of that, we saw an increase in bookings quite significantly. So it shows that the underlying demand is really, really there. And hopefully we can see a strong recovery coming very soon.
A strong recovery in 2021, a brutal winter still ahead for the airline business. Johan Lundgren there, the EasyJet CEO. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Tuesday. Just a little bit more defensive than what we've seen over the last week. It means equity futures are negative on the S&P. They are positive on the NASDAQ. And the FX market, euro dollar out to 118.70. We're up a little more than 0.1% there. Bit into the Treasury market. Yields lower by a couple of basis points on a 10-year to 0.88%. And after much demand, I'm going to say it, starts with a B, Bitcoin. I've been asked to give Bitcoin a shout out, so I will give Bitcoin a shout out. 17,000, Tom.
Yeah.
Just throwing that out there. You can take that wherever you want to go with it.
I don't know where to go with it.
I have a lot to say about Bitcoin.
Oh, well, Lisa, quick, what do you got?
Quickly, it's going toward record highs, and no one's talking about it.
Yep.
This is the story, the fact that it isn't necessarily going to be the topic of discussion at Thanksgiving, but it's had an unbelievable run. This is interesting.
I can somehow see it. I can see it, Lisa, being a topic at your house because the kids will probably have secret Bitcoin accounts
they want
you don't know about. Let's get started here. Right now on Amazon, Tom Forte with us with D.A. Davidson. He writes brilliant notes. Yeah, he's a bull on Amazon, but this, of course, on this big announcement today. Tom, I get the type 2 that this is about hurting Rite Aid, hurting CVS, taking market share away, etc. What's in it for Mr. Bezos?
So those are the implications to the competition. This is a large trillion-dollar global opportunity for Amazon. So Amazon needs these large global trillion-dollar opportunities to sustain their growth and their multiple. So my question for Amazon is, what took you so long? But I think this is a great move by Amazon.
Okay, so it's there. And, you know, I look at Amazon right now. Does this move the needle on their revenues? I mean, is it a 5-year project?
Excellent question, Tom. Collectively, I would say Amazon's healthcare efforts are needle movers. So you think about how they've kind of been forced into healthcare, testing their employees for COVID, opening these mini clinics for their employees' families. And now they're advancing their pharmacy efforts. They had PillPack. Now they're going to open an online pharmacy. I think collectively, their efforts in healthcare are needle movers.
Well, Tom, let's walk through things just quickly. The acquisition of PillPack, how does it fit into all of this? And do you think they can do this from where they are now, organically?
Complementary to the extent you think of PillPack as making it easier for consumers to follow their prescriptions. I still believe that over time they're going to have physical pharmacies that'll complement their online ones. I really thought when they acquired Whole Foods in 2017, they would devote a portion of that box to a pharmacy. So I still think this is only the beginning, but an important move for Amazon given the large total addressable market.
Tom, their Whole Foods acquisition and rollout hasn't necessarily been incredibly profitable. We don't necessarily know. They don't break out all of the data, but their forays into physical grocery stores in the past have not been as successful. Why is this time different? Why are we seeing the shares of CVS and Walgreens plummet on this news?
So excellent points. Historically, Bezos has said, your sales is my opportunity. I feel like historically, Walmart said, your gross profit's my opportunity. And Walmart went hard into generic drugs, if you remember. So there is a lot of profitability opportunity for Amazon, especially in generics. Grocery, though, is not a high-margin category. So I would say that expectations of Whole Foods generating materially higher margins were overly optimistic. The case for pharmacy is different, though.
Tom, there is a broader question, especially as Democrats have more power heading into 2021 with Joe Biden taking the role of president. There's a question of how much more antitrust concern this raises about Amazon, the fact that they're plowing into every aspect of people's lives. Does this matter if it's done organically? Does this put pressure to possibly break them up or restrain them in some capacity?
So I think that it's bipartisan support to restrain the impact of Amazon, Apple, Facebook, and Google, but I think both parties are trying to figure out how to do that. It's my understanding at one point Elizabeth Warren proposed legislation to limit acquisitions over $1 billion, so you'll see a lot of smaller acquisitions if that happens, and to your point, more companies building it organically. From an anti-competitive standpoint, though, it's hard for me to imagine that they could prove this is bad for the consumer and that this raises costs in pharmacy.
You know, I'm looking at the margins on Rite Aid, and come on, it's like a grocery store margin as well. Tom, give us the percentage margin we should see there. Forget about the cloud for now. What do they make on all the cardboard boxes on margin? What are they going to make on pharmacy as related to that and related to the razor-thin margins at Whole Foods?
Yep, so collectively, I think of Amazon as having the potential for a 20% adjusted EBITDA margin long term. If I put most profitable, least profitable, it'd be advertising first, then cloud, then pharmacy, then third-party retail, and then ... a huge...
No, but come on, give me a number. Stop. Tom, give me a number here. I get the 20% EBITDA. What's the cardboard box margin, and what's pharmacy going to bring?
Sure. Pharmacy, I think, confidently will bring more than a 10% adjusted EBITDA margin, and the first-party retail margin is flat.
Tom, great to catch up. Appreciate your time today, sir. Tom Forder there, D.A. Davidson Senior Research Analyst, putting a little bit more pressure on the pharmacy giants, Tom, and hopefully putting some pressure on them on Main Street, not just the e-commerce offering, on Main Street. Because I have to say, the compare and contrast between the Main Street shopping experience, Tom, in New York City and across the United States compared to the UK is unbelievable.
And John, I was saying this to Francine earlier. I mean, people abroad have absolutely no idea, including Canada, about the nuts pharmacy retail in America. And what he just said there, John, what Tom Forte said, if they can make 10 cents on the dollar on EBITDA on pharmacy, that's a ton of money as they create share.
I was talking more about the pristine nature of some of the shopping centres here in the United Kingdom, Tom, compared to some of the United States in New York. Can I just say Whole Foods in London is so much nicer than Whole Foods in New York? How can that be? Why does that make sense? I don't think that makes sense. How can that be?
I mean, we all shop at Whole Paycheck. I get that. What I find fascinating, John, is Whole Foods to Whole Foods, how different they are. One's like on the edge of, clean like you're talking about, pristine, and another one will be a total dump, and the next one will be even worse. I don't get it. I know
for a fact that where you go, because I know that you spend an extra 20 minutes in a cab
to go to
the Whole Foods that you prefer.
True story.
Seriously?
True story. Can't make this up, John. I told the manager at the Whole Paycheck I go to that they should pay Mrs. Keene to come to the store. Because if you compare and contrast the normal cart from the attendance by Mrs. Keene cart,
John,
Bezos is making...
Okay.
She bought Bezos' fifth house.
John, if we go into a Whole Foods, anyone out there, and they see a very tall man railing about the apples, everyone should know.
I can tell them where he'll be on Saturday morning.
John,
I can also tell you, from where he lives, there is one right around the corner that he refuses to go to because he doesn't like the standard of it.
The 365 pesto. She's buying the Bezos margin up from Perugia or somewhere in the south of Italy. It costs like $42 for a teensweens bottle like this.
Well, she's doing the right thing. She's doing the right thing.
Look at those markets.
Because she's doing that, Tom, they can give us a nice pharmacy offering as well. Beautiful thing.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
We've seen a massive momentum shift in the last week that we don't think investors should be ignoring.
The market in the next 2 months seriously will start to reprice everything.
Growth will pick up a lot in the second half of next year as people get back to normal.
Normal doesn't look like January of 2020. The world is different.
People have money and they want to spend and they can spend, and I think they're going to.
We've been in a bull market. We remain in a bull market.
We're now through the election and we can sort of face forward into what I think is going to be a very big 2021.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on simulcast. Bloomberg Radio, good morning across this nation, and Bloomberg Television as well. John, I love how we end our opening there with Christopher Verona Strategas and Ben Laidler at Tower Hudson. They are bulls. They have been right. And the real theme to me, John, this morning is a lot of people rationalizing where we are and actually beginning to rationalize, now, wait a minute, on Dow 30,000.
I see that from Bank of America with their latest fund manager survey. Cash levels down, growth expectations up, and they start to push back just a little bit. Is this bull full, and do you want to sell the vaccine news? We've heard that just a little bit more this morning, Tom, after a massive rally over the last week. Though let's be clear about something. The phrase you just used, they have been right. Not bullish and wrong, bullish and right through much of the last 8-9 months. And we often talk about the most hated bull markets, despised record highs. We've had plenty of them over the last few months, but this recovery has been underappreciated as well. I've sat here many times waiting for it to fade. It hasn't. Right. But I think now things change. The restrictions are back. The cities are closing indoor dining in the same way they were back in spring of this year. The lockdowns won't be the same as early spring, Tom, but the restrictions are there for all to see, and growth has got to take a hit off the back of that. The question is, how much of this do you tolerate?
We're marching on to Dow 30,000, and what's just as important, John, George Saravelos publishing moments ago at Deutsche Bank on the fact of a weaker dollar. dollar. How weak is weak? What do you see, John, within the literature?
Well, if you're ECB President Christine Lagarde, 2 week is 120. We saw that from the chief economist, Philip Lane. So it depends who you are and what side of the currency trade you're on. I will say this, though, in that note from Deutsche Bank that just came out in the last hour or so, this is what he had to say on Asia and China specifically. If Asia, having emerged from the COVID crisis better than others, can't generate inflation, it's hard to see which region can. Think about that when you look at this bond market and treasury yields struggling to break out through 1%.
Lisa Bramowitz, Christopher Smart at Barings, really talking about the darker tunnel, and I was really taken aback by the narrowness of the pandemic news today. I happen to focus on Sweden, where they're doing a complete capitulation from what they were doing before, but there's other news on the pandemic that's just outright grim. There's no other way to put it.
Yeah, the trajectory in the United States, more than 150,000 cases being diagnosed every single day. And again, that number is climbing exponentially, which raises questions about deaths, about capacities in hospitals. You know, the issue as we look forward is that the tunnel ahead, as you referenced, looks darker than it did earlier this year and darker than a lot of people had expected.
That strength here on a weaker dollar. Marvin Lowe is at State Street Global Macro. He is a strategist there. We're thrilled he could join us this morning. Marvin, how has your view changed in the last 2 weeks?
You know what? I think certainly the world is a bit more optimistic. I think that, we might move the timing with regard to when we can re-engage with society, but not all that much. I mean, a vaccine had been expected, and certainly some of the election risk was less than the worst case, but, not really a whole lot.
What do you make of the risk right in front of us now, Marvin, over the next couple of months in the United States of America, given what you're seeing from policymakers and the decisions they're making in the last 24 hours alone?
Yeah, absolutely. So, the fact that Washington is stalled with regard to stimulus and all of the statistics that you provided on just this next wave of the virus, appearing to have out of control aspects to it is certainly a double concern that we've got going into the end of the year. Even though, like you mentioned, the light at the end of the tunnel is bright. The tunnel itself is still pretty long.
So how do you trade this, Marvin? Do you try to? Do you just reserve an extra pile of cash while staying invested with the rest in risk assets and wait for an entry point?
Yeah, I think so. I think we're going to have volatility, so there are going to be certainly entry points. I don't think monetary policy is going to be able to let up at all. So, the Fed theoretically still has your back. I know it's kind of an uncomfortable investment thesis, certainly, but that liquidity is important in the market, and we're going to see the next stages of that over the course of the next month, and then going into the first quarter. So you'll have that, but certainly just be wary of the choppiness that's going to exist. I also don't necessarily think that rates are going to jump anytime soon because of the inflation profile, plus the Fed still being in the game.
What does a carefully balanced portfolio look like?
You know what? I do think you do. I think you've got equity exposure. I certainly think that EM is a bigger part of that. And then for the fixed income hedge, it certainly is more of a challenge. Gold is part of that, and potentially, corporate products as an income substitute for these low treasury yields starts to come into the discussion.
For our audience worldwide on Bloomberg TV and radio, we're with Marvin Lowe of State Street. For our audience on the Bloomberg terminal, you can follow this on Live Go. For our Bloomberg subscribers, India's Prime Minister Narendra Modi giving a keynote address at today's session of the Bloomberg New Economy Forum, where the focus today is cities. Again, you can watch that on Live Go on the Bloomberg terminal. Also, Tom, streaming on Bloomberg.com.
Yeah, and the overlay here with the virus and the pandemic, and John, this is really profound, is the stunning pollution of Delhi, and for that matter, so much of industrial India. I noted, John, Russia with some pollution today as well, with overlaying there maybe on a warmer Moscow. But John, this is a really important moment for India. They do have better pandemic statistics, but the overlay with pollution is challenging, to say the least.
That was the president's position over the last couple of years, that he wants to see more done from emerging economies, Tom, and not just put the United States carrying the burden. I want to bring back in Marvin Lowe of State Street. Marvin, I want to turn to geopolitical relations, not India, but the United States and China. In the New Economy Forum that we've been doing over the last 24 hours, many people have talked about a reset of U.S.-China relations. How important do you think that feature will be in the coming year with a Biden presidency?
You know what? I think it will be important. Asia and China in particular certainly have come out of this virus, a bit. I won't say stronger, but certainly with a little bit more clarity and additional clarity with regard to just how trade is going to be approached. Will certainly make looking into the region a bit easier than it has been over the last several years.
Meanwhile, Marvin, the strength that we've seen in China, when we talk about Chinese-U.S. relations, we have to also talk about the response to the virus and how China has been lauded as having a preferable response when it comes to how quickly they can exit. I'm wondering how much the strengthening of the yuan, the strengthening of the euro, the weakness of the dollar will add to an inflationary environment, even if we don't get growth here in the U.S.
Yeah, most certainly it's a concern within various emerging markets. I certainly don't see it in the developed markets as a lot of the structural issues that we had going into the pandemic ultimately will remain. But that is, from an emerging markets perspective, a case-by-case type basis that the different economies need to evaluate individually.
Marvin, I think increasingly we're thinking about tolerance levels, pain thresholds for the FX market in various countries. We understand that in Europe, the last time we breached 120, which was late August, early September, we got some pushback from the ECB. One thing we're trying to understand right now, with dollar yuan down at 650-ish, is when the Chinese start pushing back and stop tolerating that move. Do you have a level in mind? Do we know whether they like where the currency is right now?
I think they're fine where the currency is right now because of the economic backdrop that's driving it here, and we're not seeing that inflation response yet. So I think they're happy allowing it to consolidate because of the fact that their ramp out of this virus is the clearest amongst the larger economies.
It has been really strong. Marvin, it's great to catch up, sir. We appreciate your time. Marvin Lowe there of State Street. Thank you. Dollar China, dollar yuan, 655, 6.5548, Tom, on that currency pair. Quite impressive.
Not a small matter. John, I think this has been underreported in the blur of the news here, but to see yuan breaking through 7 and then where we were, 670 or so, but suddenly 655. And I don't have any knowledge on this, John. I really wonder where that tipping point is, where for Beijing it becomes an issue.
Well, on the dollar weakness story more broadly, Tom, I think there's been a lot more comfort pushing into the Asia story off the back of the Chinese strength, and increasingly more recently around the commodity story. As we start to get that vaccine news come through, you start to see the commodity currencies perform. Speaking of commodities, the move we've had in crude and the move we've had in energy equities, wow. Last week and again yesterday.
Well, there it is, 41 on West Texas Brent crude, just a nudging up on 44. John, when you went to commodities there, I thought, the response we've had this morning, it's like nothing we do matters except the international argument on Bloomberg surveillance over pesto. John, you have lit up a fire of debate over pesto. John, is it really like from Francine's Genoa is where pesto's from, or is it from the south of Italy?
It's Liguria, though I like to think that the south of Italy does everything better, Tom. But that's just my take.
John, where's Liguria?
Given my roots down in Puglia, in the northwest.
The northwest. Towards France.
Yeah, you'd like it in Portofino. That's very you.
Okay.
That's very you.
You
do well there.
A viewer emailed in and said, yes, next time we're getting the sea salt from Trapani. Where's Trapani? I have no idea.
Sicily.
Italy.
You should know this. Come on, Tom. Sicily.
Sicily? That's
it's
not near
ball
Genoa.
Getting hit by the boot.
That's like.
We'll continue this. Coming up, Greg Valliere, Chief U.S. Policy Analyst at AGF Investments. As we head down to Washington, D.C., Tom, from London and New York this morning. Good morning. Futures negative. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Joe Biden's call for Congress to pass a larger-scale stimulus package has run into swift Republican opposition. The president-elect wants something like the $2.4 trillion bill the House passed before the election, but Senate Appropriations Chairman Richard Shelby says that's not happening soon, and it probably won't happen later either. President Trump is poised to order U.S. troop cuts in Iraq and Afghanistan. A defense official says troop strength would be cut to 2,500 in each country by January the 15th. The Senate's top Republican Mitch McConnell isn't happy. He says there's little support in Congress for, quote, simply walking away from the conflicts. SpaceX's Dragon capsule has safely delivered 4 astronauts to the International Space Station. The mission is the first in NASA's history where a full crew has been ferried to the space station by a commercial vehicle. Elon Musk's company and Boeing both won contracts from the space agency. Turning now to another of Elon Musk's companies, shares of Tesla are soaring today. The electric car maker will join the S&P 500 next month as its largest ever new member. Before today, Tesla's shares had risen almost 5-fold this year, giving the company a market value of almost $390 billion. And America's efforts to revive its virus-battered economy has put on pause or thrown into reverse across much of the country. New infections are soaring at the fastest pace since the earliest days of the pandemic. California has reimposed bans on many indoor businesses. Michigan has ordered a partial 3-week shutdown. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishika Gupta. This is Bloomberg.
Better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
Bill Clinton there, the 42nd US president, on the relationship between the United States and China. We've got to make it better. Right now, with some of the issues we've got to stop making it worse, particularly the pandemic in America. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action, just a little bit more defensive. Here's a flavour of things. Futures down 21, we're down 0.6%. The Nasdaq is where the outperformance is. After the underperformance of yesterday, the bid comes back into the bond market, 0.8783% on a 10-year, down 3 basis points. And a bit of pushback from the south side. The much-followed fund manager survey from Bank of America. Cash levels down to 4.1%. From 4.4. The expectations for growth and profit optimism, 20-year high, Tom, a 20-year high. Tells you something about sentiment right now.
And, John, we've got to mention the economic data here in 12 minutes. I mean, this is not a small deal. I mean, this data is going to be important. Retail
I would agree.
Sales and the rest of it as well. Right now in politics, Kevin Cirilli with us earlier, any number of themes to go with here. Let me get this out of the way, and we can do this with Greg Vallier of AGF Investments. We rely heavily on his wisdom of a morning note. Greg, I want to talk Georgia right now, and what the Democrats need to do to respond in a clearly Republican state, 2 major Republican visible senators right now. What's the Democratic approach to take one or both of those seats?
Well, I think they'll go after the core issues that help them around the country, things like health care, the economy. But it's going to be tough. I think that this assumption that the Democrats could win both seats is not valid. I think that they'll be lucky to win one of the two.
Well, so what are the ramifications if they win one of the two? What does it mean for Senator McConnell and Senator Schumer?
It's huge, Tom. That means that McConnell controls the Senate. That means that the Biden agenda of higher taxes will fail. It means we'll pretty much get gridlock. So the stakes could not be bigger in this January 5th race in Georgia.
And Greg, once we get past January 5th, we've got about 2 weeks with an outgoing president. How do you think relations between Senate Republicans then look with the President of the United States at a time when Georgia's out of the way with?
There are still so many Republicans who are terrified to alienate the base. The base thinks that the election was stolen. The base still loves Trump. And I think that most Republicans in Congress are scared to say very much. So I think that Trump in the next couple of months will have quite an opportunity to do a lot, changing regulations, maybe getting involved in geopolitical events. It's going to be a really interesting 2 months.
All right, let's build on that, Greg. Let's talk first about international issues, people talking about that in particular with some of the changes in the Defense Department. What are you expecting on that front?
I think he'll withdraw troops, Lisa, from Afghanistan, maybe Iraq, maybe other countries. This will infuriate Republican hardliners like Mitch McConnell, who feel we're just bugging out. But the bigger story, I think, is this deep, deep antipathy that Trump has for Iran. I think he wants to do something to stop Iran's buildup of nuclear weapons. There may be targeted assassinations. As you saw in the New York Times this morning, I think Trump would want to do even more, but he's being counseled that it might not be wise.
You know, Tom has been talking about this, who has the president's ear, and I think it's a really important point as you look to the executive orders, the regulations, the foreign moves that the United States may make over the next 60 days. Who are the key members of Trump's cabinet who are kind of, I don't want to say pulling the strings, but pulling the strings here?
Well, there aren't many left, are there? I think even Attorney General Barr could be vulnerable in the purge that we're going to see over the next few weeks. I would say that Mike Pompeo is the key guy. I mean, the relationship he has with Trump is really first rate. I think Mnuchin will start to become less visible. He had a chance to get a deal with Nancy Pelosi, and they couldn't pull the trigger. I think Pompeo is going to be very influential.
Greg, just final question from me. This conversation assumes that the president understands he is an outgoing president.
Yeah,
Do you believe he believes that?
I think he knows it. He has to know that these states can't be overturned. I mean, you've got a 50,000 vote margin in Pennsylvania. You're not going to overturn that. So I think deep down, and he knows it, I think he wants to influence things for 2024, either him being on the ticket or Ivanka or Don Jr. I think Trump really thinks that's possible.
Greg Valliere, let me go full circle on where we were 2 hours ago, talking about a diminished Democratic House, Speaker Pelosi's agenda. How does she manage middle-of-the-road Democrats with a left that is more than vocal?
Great question, and there's a lot of
my only
dissent.
good one. That's it till 2022, Greg. No more great questions.
Okay, but Tom, her own troops are not happy with her. They feel that the progressive argument hurt them, defund the police hurt them, and I think her own troops are restive right now, so it's going to be a tough stretch for her. Frankly, I thought she had a chance to get $1.8 trillion out of Steve Mnuchin in October, and she could not take yes for an answer. I think that's going to haunt her.
Blew it. Greg, great to catch up. Greg Valliere, AGF Investments, Chief U.S. Policy Analyst. Tom, isn't that a story that I just think on shows like this hasn't been covered enough? The conservative pushback further down the ballot. Really clear.
Yeah, it's there. We talked to Mr. Boyle of the 2nd Congressional District of Pennsylvania, John, Philadelphia and up north, and he didn't mince any words about it. It's really front and center. They've got to defend that middle area where he is versus, of course, the Republicans and also the left as well.
Don't you find that fascinating, though, Lisa, as we go into Georgia, that the band is so wide? You've got the difference of a fiscal plan that could be a couple of $100 billion or a couple of trillion. I mean, that's the story going into Georgia. It could be one or the other.
It also highlights how fractured both the Democrat and the Republican parties are to me. I mean, we think about how hard-lined these are, but they're splintered, they're factions. And I do think about the purple medium. I mean, for example, there could be Republicans that get on board with a bigger plan. There are going to be Democrats that push back. It's going to be smaller. And these are some of the sort of the aspects that people are looking at, John.
Well, you might just have a situation where the issue is pushed again. And that's what we saw back in spring. I don't think the appetite was there at the time to push a bill through of a couple of $1 trillion. And it was only the reality of the middle of March when it finally hit them over the head, Tom, and we had lockdowns in America. That's when people woke up. I remember speaking to the administration in early March, and there was no appetite at that point to push a bill with the size that we eventually saw. It wasn't until the governors just took the decision away from them. This is what we're doing. We've got to shut down, bang. And then finally, people had to get together and make a call. Are we going to let people sit at home without a job, without getting paid, or are we going to supplement or replace their income?
John, I think you've got to the catalyst that it will be, which is the job economy. If the job economy flatlines here or gets worse, higher unemployment rate, whatever, that will be the catalyst. It always is in politics.
If these restrictions get worse. From London and New York this morning, good morning. Really important data point just around the corner. U.S. retail sales, the momentum in America and the American economy. This recovery has been impressive, perhaps underappreciated. Will it continue as we start to see more restrictions come through in America? That data point up next with Michael McKee and Mr. Dudley, formerly of the New York Fed. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
The data point 10 seconds away from London and New York this morning. Good morning. Alongside Tom Keane and Lisa Abramovich, I'm Jonathan Ferro. Equity futures are at session lows going into this one. With the economic data in America, we can bring in Bloomberg's Michael McKee. Mike, it's just crossing the terminal.
It's just slowly crossing the terminal with import prices out first, and import prices down 1/10 overall on the month. Without petroleum, it's flat. Now, here comes the numbers on the retail sales. We're slowly getting these, and here we go. A gain of 0.3% for the month of October for the month-over-month numbers. You leave out autos, and we were up 0.2%. Now, both of those are significantly lower than the forecast. The forecast was for a 0.5% gain in overall sales and a 0.6 gain in autos, ex-autos. The control group, which is what economists like to follow because it is what goes into GDP out of the retail sales numbers. Other things go in under separate categories. And the control group is up just 0.1. The forecast was for a 0.5 gain. And last month it was 1.4%. So we're really seeing some weakness in retail sales, which is kind of interesting in a negative way, because what we've seen over the last couple of months is people buying a lot of stuff and not spending much on services. And of course, service businesses are the ones that are going to be impacted by the additional shutdowns that we're seeing of restaurants. Let me take a quick look at here at where we saw some gains and losses. Electronics and appliance stores down 3.9% in October. Building materials were up 20%. And we know that housing has been strong, but a big drop in clothing stores, 12.6% on the month, and also a big drop in department stores, 11.9%. We always like to look at gasoline stations because that's really affected by price. And this is interesting, guys, because price of gasoline went down significantly during the month of October, but sales fell by 14%. Well, so it shows you the economy is slowing.
And you got to understand, folks, in the old days, we got all these numbers, boom, 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 and now McKee has to really wrestle here with how they come out slow. The revisions just came out, Michael McKee, and the revisions are demonstrably weaker than what we saw prior as well. How does this fold, not so much into Fed policy, Michael McKee, but how does it fold into the framework of inflation to come?
Well, obviously, it suggests that we're not seeing significant inflation at this point because these are dollar figure reports. And so the declines that we're seeing in a lot of these categories and the weakness we're seeing suggests there's no real additional pricing that is pushing these higher. So it's a concern. What'll be interesting to see is if there's any reaction in Washington because, of course, the stimulus talks at this point seem completely dead in the water. So we'll have to keep an eye on that. One thing I did want to check here, and I don't know if I have it right in front of me, but we have seen, and I thought this was the most interesting number that I had seen recently, is shoe sales had been down. I don't have the number right in front of me, but they were down double digits over the last 3 months. And I know that Lisa would tell you, you talk to people, they say, I don't know whether I'll ever wear dress shoes again.
Well, that's true. That's called the Dolce & Gabbana effect.
I'm wearing heels.
I'm looking, John Farrow, at the market reaction here. And with this data and with the revisions, John, it's substantial.
Let's reset here. This is the worry. It is one data point, but this is the worry, that this economy loses momentum just as we add more restrictions to it. The bid is clear. It's into the bond market. Where is the bid? At the long end of the bond market, down 5 basis points on 30s. We come in 4 on a 10-year. Last week, we topped out at 97 basis points. The vaccine news couldn't get us through 1%. The news yesterday couldn't either. We roll over. In the equity market, S&P 500 futures, session lows. Russell futures roll over. It's a downside surprise, Lisa, in the economic data. And this is where the test begins. How committed are you to the news that will come in the back half of 21 as we start to normalize? How tolerant will you be of the bad news that could come between now and then, particularly through the back end of this year, as more restrictions come through and this economic data starts to look a little bit worse?
And really the issue here is, why is this a surprise? We saw the virus numbers going up, and we saw the fact that the high frequency data showed that activity was coming down. Michael, just to sort of wrap things together, I'd love to get your sense of the coverage period of this survey and how much worse things have gotten since then when it comes to lockdowns and restrictions in response to those absolutely spiraling pandemic numbers.
Well, you make a good point, Lisa, because these advanced retail sales numbers basically cover the first half of October, and that's why we get such significant revisions, and we saw big revisions down for the month of September when you include the latter half of the month. So it doesn't portend well. One other number to just throw out here, food services and drinking places were down 14.2%, and that's the very definition of the kind of discretionary spending that we're seeing pulled back as people decide not to go out.
Michael McKee, thank you so much. Greatly appreciate it. With important data and more to come here today and in the coming the rest of this week, I should say. William Dudley is the former New York Fed president, now at Princeton, holding court as a senior research scholar. But far more than that, he developed Goldman Sachs economics pre-Jan Hatzius with Ed McKelvey, and knew that it was about theory, it was about the guesstimates, but it was also the granularity of the data. Bill Dudley joins us this morning. Dr. Dudley, I want to go right to the Dudley. It feels like an Ed McKelvey call here. I want to talk about the Dudley Beige Book, about how you use data like Mike McKee just reported.
Well, you have to look at the data in the context of what's going on elsewhere. So, you know, the fact that the retail sales were a little weaker in October reinforces the idea that as the pandemic gets worse and there's more shutdowns and restrictions, that the November data, which we haven't gotten yet, will be even softer. So, you know, we have a valley that we have to go through over the next 6 to 9 months before the vaccines arrive and we can get people vaccinated. And I think it's going to be a difficult valley to go through because the pandemic's getting worse, and there's no fiscal stimulus package that seems to be about to arrive in a timely way.
This is so important, folks, and why it's so good to have William Dudley with us right now. The only one I can think of, Bill Dudley, is Lawrence Meyer, in terms of looking at the granularity of the data week to week, as you did years ago at Goldman Sachs. What data are you looking for forward to frame out the next 2 quarters?
I think I'm going to be focused mostly on the course of the pandemic itself and the reaction of state and local governments in terms of the restrictions that they put in place and how much people actually social distance. You know, to the extent that the pandemic worsens and we have more restrictions, that's going to exert downward pressure on the economic data. And I think it's also important to recognize that when we get data like what we got today in retail sales, we're really looking in the rearview mirror. I mean, this data is October data, first half of October data. We're in a much worse place today than we were in the first half of October.
This, Bill, as you point out, is about momentum. Momentum is fading. The data, as you anticipate, is set to worsen from here because of the restrictions. Let's talk about where this leaves policymakers, specifically monetary policymakers at the moment. You wrote an op-ed piece for Bloomberg Opinion in the last month, which said quite clearly that you think, and many others share this view, that they have run out of ammunition. So, Bill, where does it leave them right now?
Well, they can do more. I mean, they haven't completely run out of ammunition in the sense that they could increase their asset purchases or they could extend the duration of the asset purchases that they make. But it just wouldn't have that much consequence because the Fed has actually succeeded in in terms of what it wanted to accomplish. It's made interest rates very low and it's made financial conditions very accommodative. The Fed did more. Would it help? A little bit. But at the end of the day, this is really about fiscal stimulus and providing support to incomes to help people get through the valley that we face in the months ahead.
On balance, Bill, as a former policymaker at the Fed, when you look at things right now, we have market participants come on this program all day, every day, 5 days a week, talking about risk or lack thereof in the credit market because of the Fed's presence in it. Is that a good thing at a time like this?
Well, I think the Fed's backstops are pretty important because it basically reassures people that there is a buyer of last resort, and so that encourages other people to be engaging in financial markets. The Fed's, the liquidity facilities that the Fed has provided actually haven't had that great amount of takedown. What's happened is that they've served as effective backstops, and I think it's very, very appropriate. Another issue that's going to get some attention is whether the Fed's going to extend the date of when these liquidity facilities lapse. Right now, they're scheduled to end at the end of December, and I think it's very likely that they'll extend them probably through at least into end of March and maybe through the first half of 2021.
Bill, a lot of people agree that the Fed stepped in and provided a backstop to a lot of companies in a good way. But there's some concern that the Fed is dramatically exacerbating inequalities, not just in terms of households, but among companies as well, because right now we're seeing the pain really being felt at smaller companies that don't even register with their bankruptcies since they simply just close up shop and they don't have access to borrowing money in credit markets in the same kind of way. Do you think that the Fed has almost whitewashed some of the pain with their policies, looking at broader markets that have this enthusiasm, and that this is somehow at this point potentially even harmful?
Well, I don't think it's harmful. I mean, in the sense that it's much better to have financial markets operating than not operating. I think the problem for the Fed is that monetary policy is a blunt instrument, which can't really do much about the fact that the impact of the pandemic falls very unequally on household and on the different types of businesses. The Fed introduced the Main Street lending program to try to get to a set of businesses that can access the capital markets very easily. And it just hasn't worked very well because there's lots of terms and conditions, and so there's been very little take-up. I think it's much better for the Fed to generate as strong economy as they can, and recognizing that there may be unequal burdens, but then that's for Congress and the administration to come forward with a fiscal package that supports those that are most disadvantaged by what's happened.
Meanwhile, next month, the Fed is expected by some, including JP Morgan, to extend the duration of their asset purchases. Do you think that based on where we are, based on what markets are doing, that they should go through with that and that they should make that decision next month, even if market conditions are similar to where they are today?
Well, I don't think there's a tremendous rush that they have to do it in December. If they waited, I don't think there'd be a great consequence with 10-year Treasury note yields below 1%. But it sort of makes sense, right? If you're buying treasuries and agency mortgage-backed securities now, not so much to support market function, but to keep long-term rates low, then why not concentrate your purchases in the long end of the market?
Dr. Dudley, I must ask you about governor-to-be. It's a very close vote right now, Judy Shelton. I want you to explain to our audience what her theory is grounded in traditional economics. If it's not classical or neoclassical, if it's not Keynesian, what is Shelton theory as you perceive it?
Well, I don't think I understand her theory, to be very blunt about it. Look, I think it's unfortunate that the Republican Congress is pushing forward to confirm Shelton and Waller. I think it would make more sense to leave those positions open so that Joe Biden could put his imprint on the Fed. End of the day, though, if Shelton were to get confirmed, I don't think it would make a huge difference in terms of how the Federal Reserve sets policy.
Bill, I must ask you, and this is so important, if you don't understand her theory, do you perceive that she's coming from some convolution of Austrian economics and a traditional historical German economics, literally from another time and place?
Well, she's been inconsistent over time, right? On one hand, she espouses sort of gold standard hard money. On the other hand, she now wants interest rates extraordinarily low, even before we entered the pandemic. So she seems to bend with the political winds. And you really want the Fed to not bend with the political winds. You want them to be independent of the political pressures.
Well, Bill, let's talk about process and just wrap things up there. I've lost count of how many meetings you must have been to at the Federal Reserve. If there was someone with a more unorthodox approach to monetary policy and policy setting, how loud could that voice possibly be if she was confirmed?
Not very loud. I mean, the way the Federal Reserve works, it's a consensus. It's a committee. The chairman sets the agenda. If you're, if you have views that are not shared by others on the committee, you can dissent, but you're not going to have any meaningful impact on policy. I think, if Shelton is confirmed, I mean, the main implication of it is just that Biden wouldn't have a chance to appoint governors to the Fed, and that might slow down his ability to put people in place that he thinks are more consistent with his policy views, not so much on monetary policy, but in terms of financial regulation and bank regulation.
Bill, great to catch up. We appreciate how open you've been in the last 10 minutes. Bill Dudley there, former New York Fed president, now at Princeton and Bloomberg Opinion columnist. And Tom, I think that's important. Whatever you think of Judy Shelton, unorthodox, needed to break up the groupthink, whatever it is, when you work through the process of the FOMC, and Michael McKee, much more familiar with it than you and I, that voice won't be that loud at those meetings.
Well,
it might make a lot of noise in the media, but when it comes to the decision-making on the FOMC, it won't be as loud at all.
And to your point, she represents a thinking of a not narrow, minute part of America. It's not obtuse. There's a lot of people that have sympathy for the theory she's expounded for years, and I think that's more important than anything we can talk about.
Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up on the programme, Barry Ritholtz of Ritholtz Wealth Management and Bloomberg opinion columnist. From London and New York this morning, good morning to you all. We decline on equity futures after a downside surprise on retail sales. It is a test of the faith of the year ahead, with the numbers set to get worse from here in the US economy. Down 27 on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Mark Zuckerberg and Jack Dorsey will be defending themselves before Congress. Again, the CEOs of Facebook and Twitter will testify before the Senate Judiciary Committee. For the second time in a month, they'll have to answer critics who say their social networks silence conservatives. Meanwhile, Senate Republicans are trying to push through the president's controversial nominee for the Federal Reserve Board of Governors, Judy Shelton. Now a third Republican has said he opposes the nomination, Lamar Alexander of Tennessee. That means approval could depend on whether all Republican senators who support Shelton show up for a possible vote this week. The strongest storm of the hurricane season has slammed into Central America. It's threatening to cripple a region already hurting from a deadly storm 2 weeks ago. Hurricane Iota came ashore along Nicaragua's northeastern coast as a Category 4 hurricane. Its winds are now 105 miles per hour, and it's likely to trigger deadly mudslides. And Amazon is making its biggest push into selling prescription drugs yet. The world's largest online retailer is launching a digital pharmacy. Shoppers can pay using their health insurance. And Prime members who don't use their insurance are eligible for discounts on the Amazon site or at about 50,000 pharmacies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
That the Fed can do all that is required at this point to support the economy is just wrong. And the Fed is really pleading for fiscal relief. I believe it's essential.
The former chair of the Fed, widely rumored to be considered for Secretary of Treasury by President-elect Biden, Chair Yellen. That was a great panel, my favorite panel so far at the New Economy Forum. Stephanie Flanders holding court with elite central bankers, Francine Lacroix with Christine Lagarde later in the U.S. morning, I believe, today. Right now, one Barry Ritholtz is with us, and we have here in this blur of news something foundational to Ritholtz's theory. And we're going to go there right now. Barry, all I want to do is I'd really like to make just 27% per year. And it's just simple. Buy Home Depot and don't do anything else. Why is that so hard to do?
Well, first you need a time machine to go back in time and buy these things when they were cheap. Hey, everything is obvious after the fact. Don't tell me what were the big winners of the past year. Tell me what the big winners are going to be next year.
What are they right now?
That's
What
a
are
much
they
more
right now?
challenging. Right. I mean, the harder issue is being able to see the future, and we have a very checkered track record as a species doing that.
Sure, and if you want to not look and predict the future, which you can't do unless you are someone very special and far more special than I, typically people go towards some sort of 60-40 allocation. There's been a lot of angst recently, and really, if people do go toward that, can they just expect to get 2%, 3% based on where Treasury yields are? Is that the new reality of today?
Clearly not. I don't do predictions, but I think it's a fairly safe probabilistic exercise to say the returns that were garnered in the past decade in fixed income are not going to be the same sort of returns we're looking at over the next 10 years. And the reason for that's pretty obvious. A decade ago, the 10-year was yielding 4%. Today, we're under 1%. So not only do you get that yield, you get the benefit of the capital gains. Unless the U.S. goes deep into negative territory, and that's a very iffy situation, the odds are against the same sort of returns in fixed income the next decade as they were the last decade.
You know, I got to say right now, we're looking at markets. We're talking these long-term allocations. Markets are skipping over the near term, and attention on this show for the past few weeks has been the dissonance between the near-term outlook, which is pretty negative, and frankly, the data that we just got having to do with the October retail sales confirming that negativity versus that very positive future without face masks, without social distancing. How do you work around that? How do you trade with that backdrop?
So first, let me just challenge a little bit of your question. I wouldn't say it was the past few weeks. Go back to the end of March. From the beginning of the second quarter, markets were looking over the valley of the pandemic, of the lockdown, of poor earnings, and looking towards a better future. That said, all that said, the big change over this year has been the attenuation of the trillions of dollars of the CARES Act that have worked its way through the economy and is now fading. When we see, one of the big things we watched over the past 2 quarters was the rising savings rate. That's not only ended, it started to reverse. We've seen fairly robust sales in retail, at least robust from what people can either do from home or go into places like Lowe's and Home Depot. That is starting to fade also. And so the big question is, are the adults going to step up, and will there be fiscal policy to match the monetary policy?
Barry, we've been in a trading zone here. You know, I don't know, I'll say September, October. It's been a broad zone with some volatility as well, even though we're lifting up to some new highs. What do you do when you're in a trading range in the equity markets? I mean, do you go to Florida? Do you read your last book? Do you write a book? What do you do in a range?
Less is more. I mean, you're definitely hinting at the right situation. My favorite historical example is to think about the period of 1966 to 1982.
Yep.
Remember, the new bull market kicked off in 1982. The Nifty 50 pretty much hit their peak in 1966 and did not surpass that for the next 16 years, certainly not on any sort of sustainable basis. The Dow just barely kissed 1,000 and did not get up and over that until 82. And if you look at people who were making regular contributions to their savings accounts, go back then, there really was no such thing as a 401k, and there were sparsely used 403bs. But if you were making regular contributions to your portfolio, to your retirement account, you went nowhere, and in fact, you lost money on a real inflation-adjusted basis. But then suddenly 82 to 87 comes along, and then even after the 87 crash, the next decade, all of that accumulation of assets during a period of sideways non-growth suddenly exploded in value because you're teeing yourself up for the next cycle. And if the next decade presents us with that, that's what long-term investors are going to have to think about. Not this cycle, but the next one.
All right, Barry, thank you so much. Barry Ritholtz doing so much with some really smart people as well. Lisa, within the blur of the morning, yield is shifted on the 10-year 0.8701. We're in 4 basis points.
Yeah, what you're seeing was a complete reversal of the reflation trade. And I think it's really interesting to see the commensurate gain in the NASDAQ futures, basically people going back to the stay-at-home stocks. What's interesting to me about this move, Tom, is it comes after the much weaker than expected October retail sales. Yeah. Why is this a surprise? We saw the numbers climbing. We saw the restrictions. We saw the fact that in the high-frequency data, people were not getting in the cars and going out to eat. And surprise, surprise, that has consequences. Yeah. And the question is, how long-lasting will the reversal of the inflation be?
What'd you learn on the show today?
I learned about your salt preferences.
Yeah, exactly. The biggest response, I love it. I'm going to tear up here. I mean, this is very, very emotional. I learn something every single day. John Farrell's looking at me like I'm supposed to know where they make salt in Italy. I have no clue about that. And Paolo out on Twitter put out maps, Lisa, of where they make the pesto up near where Francine Lacroix's from. Okay. And then way down south is where they make the salt.
Okay, you can't pin this on John. You were the one who started talking about chestnuts from a town in France that you can't pronounce. And Mrs. Keene going crazy with her pesto purchases. I will say, the other thing that I've learned from today's show is there is a growing feeling, perhaps fade the vaccine optimism. John was talking about that. We've been getting that with respect to some of the strategist notes. And are we getting the tipping point today with this retail sales data that does not even show the heart of the slowdown that we could see from
I will take your point that it is challenging retail data today, and we'll see how it goes. I'm looking more there at the labor economy than anything else. Let me look at the data right now. Red and green still on the screen. I'll tell you, you can say what you want about a movement lower in equities, but it's still red and green. NASDAQ ever so slightly positive, down negative 255. S&P futures down negative 25 near lows for the day. Again, the 10-year yield in a solid 3 basis points, 30-year bond in 4 basis points. Oil's not giving me much. And the dollar is weaker. I'm just looking at renminbi. It's been quiet here, 6.56 on the yuan. We advance forward the conversation on economics. Alan Blinder of Princeton coming up on Bloomberg. On Bloomberg Radio and on Bloomberg Television. Stay with us through the day. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They move the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the open starts right now. With equity futures down 24 on the S&P, we begin with a big issue. President-elect Joe Biden warning of a dark winter ahead.
Things are going to get much tougher before they get easier. And that requires sparing no effort to fight COVID so that we can open our businesses safely, resume our lives, and put this pandemic behind us. It's going to be difficult, but it can be done.
The United States adding 1 million new cases in the first 10 days of November alone, forcing governors to pause reopening plans, reverting back to partial lockdowns. Philadelphia introducing some of the country's tightest measures, halting indoor dining, closing museums and schools. Iowa implementing a limited mask mandate. New Jersey, Oregon, Washington State increasing restrictions yet again. And California putting more than 94% of its population in its most restrictive tier for curbs. The governor, Mr. Newsom, indicating he could go even further.
We also talked about an emergency break based upon data and based upon conditions that would provide for a framework of flexibility to tighten restrictions. We also are considering full disclosure, a little bit of a preview, the notion of a curfew.
So here we are, grappling with a darker winter. Markets have been pricing in a brighter future, an uncomfortable contrast between record COVID cases and record stock markets. Let's bring in the Bloomberg's team. Katie Lyons and Sarah Ponzek for more. Katie, the numbers are great. We've talked about them over the last several weeks. Now the policymakers responding in a bigger way.
Yeah, John, the simple fact of the matter is the virus here in the U.S. is getting worse, not better. When you look across the Atlantic over in Europe, a number of countries that have put in place more restrictive measures are starting to see the growth in COVID-19 cases level out or even fall. Places like Belgium, Germany, and France. While here in the U.S., cases just keep climbing. Over the past 7 days, the average growth rate is 37%. And just on Monday, at least 10 U.S. states logged records in terms of daily new infections. Nationally, that number was 166,000 just on Monday, very close to the peak of 177,000 earlier this year. And we have to note, John, that it isn't just about the actual case count, but also about hospitalizations. And that number currently sits above 73,000 as of Monday. Hospitalizations hitting a record every single day except one in the past week. As a result of those grim numbers, as you just ran through, a number of states moving more toward restriction rather than reopening, be it in California, on the West Coast, Oregon, Washington, and here in New York, we are very close to that 3% positivity rate that would shut schools down. So as a result, all eyes are on the possible solution, which of course is a vaccine. We did get that positive data from Moderna yesterday, 94.5% efficacy rate following Pfizer, which posted similarly positive results last week. But the fact is, John, that these vaccines, even once they're approved, still need to be scaled. They still need to be distributed. It's going to be a long time before the population is actually vaccinated. So the vaccine, yes, a longer term solution, but in the near term, John, the numbers are still looking bleak.
Kelly, thank you. The numbers are bleak, and this is the challenge. This is the question for our audience, for market participants. How committed will you be to the second half 2021 reopening trade? How tolerant will you be of the likely deterioration, worsening economic data between now and year end? The downside surprise we had on retail sales about 30 minutes ago was an early test of just that. This is what Bank of America had to say this morning. This was the most bullish fund manager survey of 2020 on the back of the vaccine election and macro. The November results show a big drop in cash, a 20-year high in GDP expectations, and a big jump in equity exposure. Sound the vaccine, we're close to full bull. For more on that, let's bring in Bloomberg's Sarah Ponzek. Hey, Sarah.
Hey, John. And Bank of America is not alone in this more pessimistic sentiment this morning. If we just take a look at futures markets this morning to see what we are shaping up for at the 9:30 open, we do see a fade. Granted, though, this is after a record high for the S&P and the Dow. At the same time, you look at the S&P up more than 10% over the last 11 days. We also had a downside surprise on retail sales. Over in Europe, the stock 600 had gained more than 15% in 11 days. We see a fade there, too. The NASDAQ, though, we do see it buoyed, of course, by Tesla's addition to the S&P 500. Tesla up 13% this morning. Tesla has a more than 3% weight in the NASDAQ, so that will help the tech-heavy stock out this morning. If we flip up the board, though, we take a look at commodities and currencies. We also look at the 10-year yield. We see a bid to safety returning today. Yesterday, we barely saw bonds budge after the Moderna news. Well, today we see yields headed lower. That's a change, 10-year at 0.8685% this morning. You also look at the offshore yuan at the highest against the U.S. dollar since 2018. This off the back of the expectations for easing political expectations, also easier trade tensions, possibly a contraction in commodities too. But bring it back to equities, because technically, if you look at a 14-day RSI for the S&P 500, not technically overbought. We have not surpassed that 70 mark that does demark that. However, we see the S&P climbing further and further and further away from its 200-day moving average. You mentioned Bank of America, but I'll give you a trifecta this morning. Cantor Fitzgerald yesterday turning tactically bearish, in part due to sentiment and the fact that positive vaccine news is now behind us. At the same time, Peter Cheer of Academy Securities writing this morning that this is the perfect storm of, quote, sell the news moments. He's referring to the vaccine news behind us, the election behind us, Tesla being added to the S&P 500. So this growing bearishness asserting itself in the trade lightly this morning and also across many strategist notes too, John.
Trying to top tick is a tough business. Sarah, it's great to catch up. We'll touch base with Sarah a little bit later this hour. Morgan Stanley's Mike Wilson is just leaning in, continues to lean in, seeing opportunities in the reflation trade and writing the following. We continue to lean cyclically in our recommendations. This means small over large and cyclicals over defensives. The recovery will be surprisingly V-shaped and bring inflationary pressure. Mike, I'm pleased to say, joins us now for more. Mike, let's just start with a number from 36 minutes ago. It's an early test of how tolerant people will be of potentially some bad news between now and year end. How tolerant will you be of that, Mike?
Well, John, it's always good to be with you here. I think you have summed it up well as usual in the opening of this show. I mean, we find ourselves at a juxtaposition between the 12-month view, which is unequivocally bullish to us, with this year-end conundrum around, we have a vaccine, but we have to deal with the rising case counts, not to mention just getting through the runoff elections and positioning and sentiment, which has gotten a little frothy. So that's the exact question we've been asking our clients is how committed do you want to be to your 12-month view? And our experience suggests that people are committed until it starts to go against them. And it's interesting, we are starting to see some sell the news type calls out there. We would agree with that perhaps in the short term. I think most people would assume that you could have a 2, 3, 4% drawdown at any time. That can easily be managed, and you should definitely stay committed through that. If you think it's going to be something more significant than that, then you need to probably de-risk a bit. We're trying to stay committed for our longer-term accounts, and so our message to our longer-term accounts has been very consistent all year, John. As you know, we're in a recovery. We want to be more cyclically geared. We want to be small cap. We want to stay with that view. However, we understand that our institutional clients who are more trading-oriented may have to deal with some volatility here between now and year end. And we feel like the 3,600, the risk reward isn't great for new money entry here. And we could see a drawdown in the short term. That's the tough part of this game. You have to kind of do the short term with the long term. And it just depends on your time horizon.
Mike, it would be disingenuous of me to sit here and characterize you as an Uber bull. You had your trading range. The upper end of the range was 3,500. You came on this program once we got in and around that level and said the risk reward wasn't pretty. You're now looking for 3,900, year end 2021. That's the destination. Can we talk about the path just a little bit more, Mike? The kind of things you expect to look for in the coming months. One thing that's really struck me is how underappreciated this recovery has been up until this point. No doubt the data now will deteriorate just off the back of the restrictions we're seeing across America. Just walk me through your latest thinking a little bit more, Mike.
Yeah, I think this is the more interesting part of investing at the moment. It's not about the index so much; it's about what's going on underneath the surface. And there, whether it's a rotation call, whether it's sort of the median stock. And that's really our view. So I think this is the path we're looking towards, and where our call may be a bit differentiated. So we've been more bullish on the economy. We've been more bullish on the earnings recovery, and I think we're still there. We're looking for something like close to $180 in earnings next year for the S&P 500. Okay. However, where we're also out of consensus is we think multiples are going to come down over the course of the next year from, call it 22 times down to towards 20 times. So it's this trade-off between better earnings growth but lower multiples. And in round numbers, I would suggest that we're going to have about the forward 12-month numbers will go up about 20%, and the multiple will come down about 10%. Hence our 10% upside to the S&P 500. Now, an average stock could see much more upside than that, right? Because we see many stocks out there that are more cyclically geared that could see, earnings revisions that could be close to 30, 40, 50%. And their multiples, don't have to come down nearly as that much. So we see 20% upside for the average stock with 10% upside for the S&P 500, which creates a wonderful stock picking opportunity for active managers. And once again, we want to skew our longs towards those companies that have greater operating leverage potential in a booming economy next year, once we get through this near-term concern. And that would mean you want to skew down the cap curve and towards the more cyclically oriented sectors.
I want to bring the other asset classes into the mix as well. The other call that you and the team have got is 145 on a US 10-year. Do you need the bond market to come with you, Mike? And do you see the same kind of story that you see in equities, short-term, different to what you see long-term? Because what I've seen in the bond market this week is just a 10-year Treasury that's not playing bull in that rotation trade.
That's right. And somebody else mentioned it earlier, which I think is spot on, which is that we had the vaccine announcement from Pfizer last week, very bullish, and rates really had a big move. And we had the big, rotation towards the reopening stocks. Then when the Moderna news came yesterday, which was fairly well expected, even though it was better in terms of the efficacy, it was kind of a muted move in some of the reopening stocks. It was good, but not as powerful as it was with the Pfizer news. And rates didn't budge, okay? And rates are actually below where they were now prior to the Moderna release. I think there's a lot of information in that, and what it tells you is the market's tired. Like, we've priced a lot of this good news. As you know, we came in and made a buy trading call right before the election because we were down at the low end of our range. And I just think that that's the strategy that has served us well for the last couple of months. And I think we're still in that range, call it 3,150 to 3,600 now. It's been extended a little bit. And so the risk reward, once again, will be much more attractive if we can have a bit of a drawdown. And that's a bond story as much as it is a stock story. If yields probably go lower in this sort of what I would call a growth scare, short-term growth scare in a continuing V-shaped recovery.
Keep the faith. Trust the recovery. The message from the team at Morgan Stanley. Mike, great to catch up, sir. As always, we appreciate your time. Busy morning for everyone. Let's continue the conversation in this market with Bloomberg's Abigail Dillisel. Hey, Abigail.
Hi there, John. Well, lots of big name movers to take a look at. Starting out with Tesla, shares are absolutely soaring, helping to explain, as Sarah was mentioning, the NASDAQ 100 futures are higher as the S&P 500 falls. The stock up about 13% in the pre-market. On the news, it is finally being added to the S&P 500. This means index funds and PMs have to buy the stock. Now, this stock already up in a huge way this year. The best performer for the NASDAQ 100 up 388% into today. Zoom is the next best stock, up 173%. So after today, Tesla will clearly be in charge. Also on the move today, big pharma names. This on the news that Warren Buffett's Berkshire Hathaway has added positions to the like of Merck, Bristol Myers, AbbVie, Pfizer. It seems that the firm wants exposure to COVID vaccines and other therapies. However, equally interesting, they have trimmed positions in banks, including Wells Fargo, PNC, and JP Morgan. That, of course, is a part of the reopening trade, the reflation trade. These banks down on this news of Buffett trimming the banks. But also we do, of course, have bonds rallying on a bit of uncertainty this morning. That means yields are down. The yield curve is in. That is also weighing on banks as well, John.
It's an early test. Abigail, thank you. Thank you very much. It is the test. The two questions we'll keep asking through the next hour on this program. How committed will you be to the second half 2021 reopening trade? How tolerant will you be of worse economic data between now and year end? That'll be the test as we get more restrictions in the United States of America off the back of COVID-19 spreading through the Midwest and beyond. Up next on this program, President-elect Joe Biden urging Congress to pass a larger-scale stimulus package. That conversation coming up next with PGIM's Greg Peters from London and New York this morning. Good morning. This is Bloomberg.
of the measures involved in protecting the drivers, protecting the passengers, and sort of how the business has recovered? Like, where is ride sharing? Where is Didi in China now?
Sure. When the pandemic came, the business basically came off cliff suddenly. So it was quite dramatic around January, February, and we gradually see recovery starting from April. And right now, we are fully back. We are fully back and all-time high. We are serving 60 million rides every day, which is very nice. So what we have done over the past, more than half a year, basically, number one, we need to make sure our drivers and passengers are safe. So, we urge our drivers to wear masks, encourage our passengers to wear masks. We send out free masks for everyone. And also, we have set up this relief fund for our drivers and passengers, especially for the quarantined, if drivers got quarantined or infected, just in case. And thirdly, we have been working with the insurance company and leasing companies so we can extend the lease payment. So there have been a lot of things we have done in other countries like Latin America, in Australia. We have also installed plastic dividers so that we can keep passengers and drivers separated, so to lower the infection chance. So there have been a number of things. One thing I feel extremely proud of was the Didi Hero initiative. Because back then, I don't know, Neil, if you remember, there were no public transportation in a lot of cities. And doctors and nurses, healthcare givers, they just can't get around. After a whole day work, they have to walk home. A lot of them need to walk for an hour or even 2 hours. So what we have done is really organize a team of drivers, and they volunteer themselves. More than 140,000 drivers in Wuhan volunteer themselves to offer free rides for the drivers. And that's what we have done. So we learn to be a resilient organization, and we learn how to, ride out the cycles, through the whole pandemic period.
Meantime, while things might be getting back to a sort of normal in China, cases are skyrocketing almost everywhere else. Carlo, you're not just gathering data about cities, you're also an architect, you are an inventor, you're an engineer, and I understand you're working on turning shipping containers into mobile isolation and ICU wards that could be, pitched within a matter of hours. Tell us about that.
Sure, that was one of the first projects we did when the pandemic hit. I think like many of us, we asked ourselves, how can we contribute with our skills to what is happening? And, the interesting thing is that we need, again, it's about innovation. We need to find new ways to address the crisis very, very quickly. And so we wanted to build more ICUs and wanted to scale up quickly. What we did was actually do the project in open source. So share, first of all, develop all the drawings with the group. The group, within a matter of a couple of weeks, grew to over 1,000 people. And then share the drawings so that different people can actually take them and use them for fabrication. And the amazing thing is that by doing this, by parallelizing, by doing what people do with software, with open source software, we're able to do something normally in a traditional design approach would take at least 6 months to cut it down to 6 weeks. And that was, I think, for us was very, very exciting. Now there's companies fabricating Curapods. They're called Curapods all over the world, here in Italy, in the Emirates, in the US, in Canada. One of my favorites is actually a team of people in Canada used to turn shipping containers into containers for growing marijuana legally. It's legal in Canada. And actually, they use our drawings in order to change their business. Now they're making intensive care units for the Canadian market. So somehow, again, the virus is code, genetic code that replicates and attacks us. And if you design code, use the code of design, the code of human intelligence in a similar way, by spreading and replicating and parallelizing, we can fight fast in a much better way than how we do normally. Again, an example of how the crisis forces us to rethink the way we operate. You lose Emily. Should we just continue the conversation here? It looks like there's a problem. We can continue the conversation amongst ourselves.
Hi, and I'm just taking off my sweater a little bit here. Technology, it can be our savior and it can be our nemesis. So we're going to hopefully get Emily back up. In the meantime, Jean, Carlo, Neil, I'm going to continue with the conversation, if I may. Emily getting you guys off to a wonderful start. And I want to jump in because you guys really laid the ground of kind of what we've seen post-pandemic, some of the responses. And I think, let's go to technology. I mean, do we think that there are technologies out there that will ultimately kind of save our cities? And let me bring in Neil on this, because I do wonder, what is it that we're going to kind of hold in this moment and that will carry us into the future? And I do wonder what you think about that.
Well, I think many of those applications have been there before, and their adoption has accelerated because of COVID. And I do believe some of those will stay there for the consumers to continue to use for many years to come, because this has served a great period of time for education purpose. For example, online hospital services, which is a initiative that many hospital has taken in the last several years. But during COVID period of time, you see that service has been picked up pretty dramatically, thanks to obviously technology being offered. But also very importantly now that many of those hospitals have secured an online hospital service license, which gives them the opportunity to sell online medical services. And they can leverage those large e-commerce companies to deliver the drugs. And at the same time, we are seeing the local government allow that, the medical insurance can cover, the drug and medical services. That give another boost to online hospital service, and which I think will probably be a, reflection point for the China medical, sector. And I'm pretty sure that, many of those new applications will be developed along those platforms.
I'm back, Carol. Thank you so much for jumping in. Jean, I want to talk to you about how some of the innovations that Didi has been making at this time. You've been working on piloting grocery delivery, which, as I understand it, started off with trying to help people get essential goods delivered. And now it's growing incredibly quickly. I caught you on the phone in Chengdu, where you're just experimenting, but already orders are up to like 7 million a day. Talk to us about that project.
Sure. I think that's also some initiative we have been taking after post-pandemic because we noticed people prefer to stay home and order groceries. So we started the initiative around February, and the team worked really, really hard. So we have seen very promising numbers. It means there's huge value in this market. And at the same time, we have also been trying some other innovation. For example, we just launched the first version of EV designed for rideshare, worldwide first designed for rideshare version of EV, and that's very rideshare driven, if you will. So we have, the power sliding doors, so people can get in and out more easily, much more spacious space, less space for this type of car, this grade of cars. And also, inside of car entertaining system, et cetera, et cetera. So these will be very popular, we would imagine, because people would want an alternative to public transportation. So we want to make sure we can offer more comfortable and affordable services. So after trying everything on software, on technology, online technology, we have been going hardware. So that's the new initiative we feel extremely excited about. And also autonomous driving, of course. We think that will be the ultimate solution for safety, for health problems. So that's also something we have been investing very heavily in.
Now, as much as there's been a flight to suburbs in the midst of the pandemic, COVID is actually having a huge impact on the urban poor. And the UN estimates that 68% of the world's population will actually live in urban areas by 2050. Carlo, I'm curious, what should architects, what should governments, what should urban planners be doing to make sure that cities, as they change so rapidly, are also resilient, greener, and more equitable?
Yeah, well, I'll go back to a couple of things to what we were saying before, right? Ultimately, cities, the way we think about the future of cities should really rest in the hands of citizens. So I think it's creating healthy feedback loops of innovation, trying something, get people's feedback, decide what works, what doesn't work, and by doing that, accelerate urban evolution. I think that as a method seems to be the best way to achieve what you're saying. There's not one recipe fit all cities. Every city is different, even different climate, different materials, different morphology of the city means they will have different type of responses, but it's more about the methodology to do this. Now, I wanted to add something about what was just mentioned about mobility, and certainly, I can see all of those innovations happening and going to change a lot the ride-hailing market. At the same time, there's something I think is very interesting, which is micromobility. And micromobility, for me, is interesting for two reasons. The first reason is that certainly is much more efficient than a car, a 5-seater, to move like 70, 80 kilos for less than 2 miles on average. So micromobility is much more efficient in terms of energy usage or street usage. Micromobility, as you know, it's e-bikes, scooters, and many more form factors that I think will emerge in the next few years. Now, the problem is that micromobility has been losing a lot of money, bleeding a lot of money over the past 2 or 3 years. And it would be really bad if it were to miss and lose that mode of transportation. Micromobility is also making public transportation much more appealing because you can take the subway and then do your last mile with a scooter. You jump from one mode into another mode, some kind of multimodality on the spot. Now, we are working on that at MIT. Actually, one of our companies, the first company we spun off for the lab called Super Pedestrian, that operates micromobility which is called Link. And there we're using a lot of artificial intelligence to do self-maintenance and try to turn an industry that at the moment doesn't work into something that could really have a future in our cities. At the moment, we have solutions, but most of them are not financially viable. So if we fix it, I think micromobility could actually be a great, open up a great future, both in everywhere on the planet, including in the global south, for rethinking mobility in cities.
We have quite an eloquent question, a few eloquent questions coming in from Chinese social media. Neil, I'll throw this one out to you. Remote education and work during COVID have exposed a big urban digital divide. How can governments and tech firms narrow that digital divide? I know you're doing a lot of work in online education, so figured you could swing at that.
Well, I think, online education really have played a role to providing a level playground for everyone. I think, it's very, very important that such services could be, provided online because, in many, cities in China, you really lack of high quality teachers. But with online programs today, for example, through our portfolio company, Joyabang and VIP Kid, kids in a very remote city could actually enjoy the very best teacher through such a platform. And I think that's a very important way to narrow the gap between the different quality of education offered in the big city versus the countryside. And online education has clearly been accelerated during the COVID. In the past, people used that mostly as a tutoring tool for kids, but now we're talking about mainstream. We're talking about, the junior high school, the senior high school, even the college have adopting those, programs and tools to reach out, all the kids. Some of those may not able to travel to the classroom in person.
Now, Jean, there has been, go ahead, Carlo, yeah.
Oh. No, I wanted to add something very quick about this. I think certainly education is going to be disrupted. And there's a very interesting model which is emerging now. I was just talking the other day to to some Harvard students. And what they did, they actually created something that you could call like a small commune or kibbutz to study together. And I think that what is missing to just online education. We've seen online education, MOOCs, that were very popular a few years ago, and then we realized a university education is much more than that. But if you combine the MOOCs with also the fact that people can come together and create small communities, small campuses, distributed across the planet, in big cities, in small places, I think that model could really be the model that closes the gap, as you're saying, and tries to develop a new university model. We're still working with a university that was designed in the year 1000 in Bologna, and then in Oxbridge, in Cambridge and Oxford, a couple of centuries later. So I think it's probably time to rethink it.
Now, we actually do have results of our poll question. And a reminder, the question is, which technologies will take off post-COVID? Facial recognition coming in at 21%, autonomous cars, robot and drone deliveries, virtual presence at 48%. That is the winner. Neil, does that sound about right to you?
Well, I'm pretty sure this is probably a very important product, and people are very looking forward to. But I think at this moment, mostly those applications are limited to games or some specific industrial vertical applications. It's going to take some time because we need hardware to improvement, we need 5G and all that. So I think I'm very optimistic, but probably it's going to take a bit while for such services to be more sort of appealing to broader base of users.
I'm hoping the next time we do this, we can all be with each other virtually, because it would be a lot smoother. I want to talk about drones and robotics. And Jean, any chances of Didi delivering groceries via drones in the near future?
Yeah, absolutely. We can always do it. For the, robotics, we launched the autonomous, a robo-taxi in June, and we have seen very good results and a lot of very positive feedback from our users. And we do believe this is the ultimate solution, when we face problems, like now in pandemic. It's the ultimate solution to kill accidents, right? However, it will take some time to get it commercially effective, right? It can, in small lab tests, it all works really well. However, we believe it would need to take some time to really get it to people and work effectively. But that's something we have been working on.
Now, before I go,
I just want to add one thing, where we talked about pandemic and, as a private business, what we have learned is really to do the right thing, to do the right and hard thing and keep doing it. So, for example, investing in autonomous driving or investing in safety or investing in offline supporting systems. These are all very long-term investment work and take a lot of effort and commitment. So that's what we have learned from, the whole pandemic.
Now, before we go, I want to touch on.
Yeah.
Okay. I want to touch on the political environment because, technology is great, but we also need the partnership of government. And former U.S. Secretary of State Henry Kissinger told our New Economy Forum audience yesterday that he's worried that the tensions between the U.S. and China could escalate to a military conflict at some point if something doesn't change. I'm curious how the market environment, the geopolitical environment, in the midst of a pandemic, Neil, is impacting the strategy and the choices that you are making.
Not much, I have to say. I think, in the last 10 years, the two areas we have been focused a lot in China, one is digital technology, which means obviously every single sector is going through digitalizations, whether it's consumer technology or whether it's enterprise software. And I see this actually has been picking up very rapidly the last 12 months. The other area which we have spent a lot of time on is healthcare. And obviously during the COVID period, we see people paying more attention to this area. And so our investment in the medtech and in the biotech area has been paid off pretty handsomely. And we're very lucky and proud that some of our portfolio company participated in launching the RNA testing kit. And one of our portfolio company actually was a UK-based vaccine company who worked with Oxford and AstraZeneca in try to come up with the most advanced vaccine drug, vaccine product to address the COVID. So I think the scene hasn't really changed, and I only see these continue to become very important trends in China in the next several years.
So that is the new reality, I guess, we're going to live in. Carlo, we have just a few seconds left. Are we going to recognize our post-pandemic world 10 years from now? Will it have changed so much that we won't be able to believe it?
Well, I think probably this pandemic has been accelerating a lot of existing trends. Somehow it also happened at the right time. Think about the same pandemic 20 years ago, without the ability of working remotely, of doing smart work and so on. We've been totally different. We've been much more stuck. And so all this acceleration, I think, yes, we're going to see it in 10 years. At the same time, I think, this is not going to be a big change for cities. Cities have seen many pandemics over the past 10,000 years, since the beginning of cities, around that time, 10,000 years ago. Many pandemics, even more devastating pandemics, like the pandemic in the 14th century in Venice killed over 60%, 60 of the population, and still the city went back. And I think this time as well, we'll see big cities come back quite soon, I believe. They are kind of a powerful magnet to bring us together in physical space. That's what we need. That's what we need and what we miss, especially now. I mean, you said it just before. Next time we need to meet in person, like we did last time.
Absolutely. Let's hope. Jean, we got a little bit more time, and I'm curious, what do you think, based on all the work that you're doing at Didi, what does 10 years, the world, China, the business look like to you?
Sure. I think because of the shared vehicle, electric vehicle, and autonomous driving, at least we will see much fewer parking lots inside of the city, and people will use more bikes, e-bikes, like what Carlos said, and also, people will prefer to order groceries at home. So it will be a greener city. It will be more cleaner air, and there will be a lot of parks in the cities.
Neil, would you agree with that based on what you're seeing from entrepreneurs right now?
Yeah, absolutely. I think, all those technology applications really depend on a more advanced, mobile connectivity. So 5G, I think, is very important. And obviously, all those applications could be run on 5G in a more effective way. And if you look at 10 years, probably we're going to looking at 6G. We don't know what technology is going to be, come out of that, but at least we all can imagine that everything will be digitalized in a way that, there's no, limitation on bandwidth. And obviously, I also feel like, robotics, as you mentioned, will come to, every single corner of our life, not only in industrial applications, but also probably, as home appliance, as, important tools for hospitals, for hotels and restaurants, and so on.
Now, we're getting more questions from the audience, and there seems to be a theme about resilience, about the poor. The latest question coming in from Tracy Zhou from Jiangsu in China about how we build more resilient cities. Jean, there's been an urgency here in the United States when it comes to gig workers to give them better protections. How are you thinking about that in terms of, potentially rewriting the social contract with drivers, with the folks who are delivering your groceries, who are, I'm sure, grateful to have a job, but would also like the protections that would come along with it in a contract position?
Sure. Didi is now, I would say, one of the largest gig platforms, and we are also the largest flexible work platform. We actually support work opportunities for more than 14 million drivers, right? And a lot of them, this is their second job, and 4 million of them, are laid off workers. 10% are women. A lot of them are single mom or, work from home mom. So, I think the point for Didi is how can we provide more income, more meaningful income for them? Because everyone, needs a second chance. A lot of them have been laid off and, don't want to go out for interviews. So that's the minimum we can do. And that's what we have been thinking about. And in terms of protection, for example, during the pandemic, we have set up the relief fund, and we have been working with insurance companies together to provide better insurance package for our drivers. And we have been working on the ecosystem so we can build a more healthy ecosystem for our users, for our drivers on this platform.
Now, Carlo, given that, Neil founded an online travel business, Jean is in the business of ride sharing, do you think that transportation and the way we move around the world will ever go back to normal post-pandemic? Like, are we going to go back to riding buses and subways to work? How many of us are actually going to go back to work at all?
Yeah, no, I think we need to go back to work. Actually, we've been doing some big data analytics on the MIT campus. So what you see is that, if you remove physical space, we closed the campus at MIT in the middle of March 2020, still closed. It will be closed until the spring, most likely. So what you see is that when you remove physical space, then our social networks become much more fragile. We lose a lot of the weak ties. The weak ties connect us to new ideas, to new people, to new groups, new different social circles. And I think physical space is very important for that. So because of that, I really believe we'll go back to physical space. And think also about, all what we've been doing, all the money we've invested over the past few years for team building. That was about, bringing people together in the same place and doing activities together. That is certainly going to be even more important in the future. At the same time, I think that we will also keep the flexibility we came to enjoy over the past few months. And so if we keep that flexibility, still it means, we need to rethink a lot of our offices, doing much more hot desking. If we go to the office, so as I said, I believe we will go back to the office, but maybe we'll go just 3 days per week, even 2 days per week. At the moment in Paris, the rule is 2 days of smart working, 2 plus 3. So 2 days of smart working, 3 days in the office. Some people suggest it's going to be in the future more like 3 plus 2. But whatever the balance is, then that means, we need to rethink the office because of this new pattern. To think about the choreography that will allow us to achieve more when we are together in the office, even if we spend less time there. Now, just to finish, another thing I think we will not get back is certainly about international travel. I think, we're all conversant now with all these kind of tools, even, just what we're using now or similar. And so I think the crazy things we've done of this kind of round-the-world trips for a 2-hour meeting, hopefully that will not come back. That was a big toll on the planet and on us.
Hopefully the virtual presence capabilities will help with that. Neil, 2 of the most prominent VCs here in the United States, Bill Gurley and Reid Hoffman, told me that they are now investing in entrepreneurs that they've never met, companies that don't have offices or office space. Reid Hoffman said that, sometimes he's wondering, is this really real? Are you seeing that in China, or is the state of play more normal at this point?
Well, I do think, a lot of those companies now use virtual meetings and different type of online working tools to, get connected, even though, they, probably have, different, physical offices. But at the same time, I think people will still want to get together. I mean, I feel like, you have to get together, to build company cultures and get to know each other. So, I mean, it's very important to use those online tools.
I'm placing an order to sell short euro at 118,785. Wow, it moves too fast. Wow. I have to cancel it. Order was cancelled.
Back to normal, or will things about Didi, the way you do business, the way that you operate, be forever changed as a result of the pandemic and what you've learned?
Sure. First of all, we felt very lucky that, the business came back very nicely and, it's all-time high again. However, the business definitely changed. The organization transformed. We have learned a lot. First of all, we've learned how to get courage, doing the right thing, to make the right call. There are a lot of very tough decisions to be made during the pandemic, right? Whether we form the task force, how do we take the risk? And secondly, how can we be true to ourselves? Because before, for young companies like this, we tend to, picture a very beautiful future. However, after pandemic, right, we have learned, everyone should be true to themselves, and, we need to learn, it could not be perfect. We are not perfect, so we just have to try our best. So, I think that's the second thing we have learned, and we have been doing it. We have been, holding all hands meeting online and, tell everyone what was going on during the pandemic. So everyone got, aligned. And third thing we have learned is empathy, again, understanding people's needs, understand, people from different countries, because we have global business, how users, what users want during this crisis. So there are a lot of, we have learned, and I do believe that also how our country wins this battle, right? Courage, to be true to ourselves, to be transparent, and also to be empathetic and taking care of people.
And with that uplifting and eloquent thought, I think we will end it there. Jean Liu, Neil Shen, Carlo Ratti, thank you all for joining us. I'm excited to see which of your predictions hold true for our world and our cities. Thank you all for taking the time to join us.
Thanks a lot. Thank you.
All right, Emily, thank you so much. And real troopers, as I said, technology can be really good, and it can also drive us a little crazy. In our next conversation, we're going to talk about startup cities, the post-pandemic reboot. We're going to talk about how can cities restart the engine of economic growth. Our speakers are Mohammed Alabar, founder of Amar Properties. We also have Zhang Xin, co-founder and chief executive officer of Soho China. And the moderator will be Jonathan Wetzel, Global Institute Director and Senior Partner, Shanghai McKinsey & Company. Jonathan, take it away.
Great. Well, thank you. And look forward to this conversation about cities in the post-COVID context, rebooting for a new growth era. And with me are two developers who have built cities, who have been part of the tremendous growth story of emerging markets. Only appropriate for the New Economy Forum to have this chance to talk to Xin and Mr. Alabar about their progress and what they see. So I'm going to start perhaps actually with you, Xin. We've seen Soho over the years become almost the standard for aspiring Chinese people to live in the city, and then all of a sudden we had this. We had COVID, and now, as we were just hearing from Jean, we're out of it. I mean, China is back. So maybe we could just start with a bit of your take on what happened, and are we in fact back in China? What happened to the city? What happened to the buildings? What happened to the people in the buildings over the last, let's say, over this year, over the 2020? Mm-hmm.
Sure. When the virus first broke out in China, it was, scary. The whole cities and the whole country was shut down. But remember, we had SARS a while ago, so I think China was better prepared for the crisis, as people kind of knew what it was like to be locked down, and knew what it was like to wear masks, knew what it was like to stay inside. So we saw the cities were completely quiet. There was hardly anybody was on the streets, and the first quarter was that way. And then second quarter, I think around May, we started seeing people going back to work. And it was still very limited. When in the beginning of going back to work, we were all so worried about how do we make sure that people coming to the buildings are safe. So we put infrared cameras in every entrance of the buildings and making sure that anyone who comes in were body temperature checked. And so, it was, and then, China had this health QR code. So then we were checking everybody's QR code. So let me just explain the QR code. Everyone has been given a QR code. So you have it on your cell phone. And if you have a green, that means you're healthy. You can go anywhere. If you are orange, that means you had a history. And then if you're red, you really should be quarantining or in the hospital. So that was very helpful in terms of tracing and identifying who potentially has had the health problem. And I think with that, with the tracing, with the all that technology, we'll very quickly see that the buildings were back to, quickly went back to the 70%. Pre-COVID buildings were all 95% occupied. Then we went down to 0, then we went up to 50%, and probably by middle of this year, we saw like 70% went up. But restaurants were still really careful. Then, people were still careful not to go to restaurant to eat. So retail continued to suffer. And then really what we saw a complete comeback was October. And the first week of October, China had the national holiday when, hotels are fully booked, restaurants are fully booked, and everywhere else, everywhere there's like people. So by now, we're actually seeing all the buildings back to pre-COVID level of mid-90s occupancy. And even though China has no COVID really, we're still seeing, you see it on the street that half of the people still wearing masks. And I think, but in terms of back to work is really, everything is back to normal now.
Well, I mean, that's an encouraging picture. And I want to come back to you in terms of what might be different in terms of how work is done and other aspects. But perhaps I could first turn to you, Mr. Albar, and sort of, is that the picture that we see as well in Dubai and the Emirates and the region? Or, I mean, you cover so many areas in terms of growth. How have you seen this develop? And then also, what is your outlook in the sense of when will it come back?
Well, I think we all can agree on one thing, that this is really an attack on humanity. I mean, call it whatever you want to call it, but this is just so strange. It's so large, devastating. Of course, let me tell you one thing first, is that when this happened, we really didn't know what to do. We were scared, and I probably respect a lot of CEOs who knew what to do. We didn't know what to do. If you're, as an organization, if your balance sheet is not right, if you don't have the right talent, if you don't have the right company, if you're not planning way ahead, you're really in big trouble. When it comes to, we operate across 14 countries and across different, I have the real estate business, I have my large e-commerce platform in the Middle East, and I do have my very large food business. But in summary, I would say the following. The great learning for me is that during this unfortunate event, government have really shown their quality. And one of the things that really I'm starting to understand is that leadership in this is so critical. You've got, unfortunately, leadership in China, I think part of Europe, and you've got America, where thank God they only have two political parties, not more. They are fighting each other. While Americans are getting sick, more people are dying, and the fight is going on. That is one agony. The second agony, worldwide, you've got the poor getting poorer, the poor is losing their jobs, while stock market is rocketing. Okay, I'm a businessman, I have 200,000 people working for me, but this is something that hits me in the face as a result of the virus. The effect on the lower income, mid-income, lower income people is catastrophic. And that really worries me as a businessman. It's not all, it's not all about, okay, will I survive during this crisis? What's happened to the society around me? Because I survive with society, and we have social responsibilities. So I'm asking all of us: is that what does this all mean for the people who can't get health care? Again, does it mean that privatization have failed? Because we all keep talking about privatization, but does privatization mean we can privatize healthcare where people don't have enough coverage like America, while a country like UAE and Egypt, the military have came in, took over, built hospitals on site, while there is a lot of government hospital, and that's what happened in China. So I guess who is right, who is wrong? I'm not saying we are right, you are wrong, but we need to think again. But this is the fact of life. Change is the way we live. If it's technology